Welcome to Corporate Finance and our first lecture. Today we're going to talk about the time value of money. We're going to start off with some intuition, then I want to introduce the tools associated with the time value of money, namely the discount factor and the timeline. Finally, I want to apply those tools to move money back in time via a process called discounting. Let's get started. Hey everybody, welcome to Corporate Finance and our first lecture on the time value of money, and we're going to start off with some intuition and discounting. In particular, I want to give everybody a good sense of what the time value of money means in a context with which they're already familiar. Then I want to introduce some tools, and then I want to apply those tools to our first financial problems. So, some intuition. Hopefully in a setting with which everybody's already comfortable and familiar with, that's foreign currency. Imagine I've got 100 euros and $100, and I ask the question, how much money do I have? Well, we can't answer that, at least not yet, because we can't add euros to dollars, right? What we need to do is what? We need to convert the euros to dollars to find out how much we have in dollars, or convert the dollars to euros to find out how much we have in euros. And we do this using an exchange rate. And there's nothing special in this example that there's only two currencies. If I had three currencies, euros, dollars, and yuan, I would have to convert two of the currencies into one currency, one base currency, whether it's into yuan, dollars, or euros, using the appropriate exchange rates in order to answer the question how much money I have, or in order to add the different currencies. So what's the message? Well, look, we can't add or subtract different currencies. We have to convert the currencies to a common base currency using an exchange rate. So what does this have to do with the time value of money? Well, the time value of money refers to the fact that money received or paid at different times is like different currencies. You can't add it. Money has a time unit. What you have to do is you have to convert to a common base unit in order to aggregate it, and to do that, we need an exchange rate for time. So let's talk about some of the tools that we're going to use to accomplish this task. So first, the timeline, which is exactly what it sounds like. I've got a timeline here that lays out different time periods, and these periods could be anything. They could be years, they could be months, they could be days, they could be decades. Typically, we refer to time period 0 as today, or now, or the point at which we're answering the question. Okay? Underneath that, we lay out our cash flows, denoted by CF. The subscript denotes the time period, and this is nothing more than a visual representation of when money is coming or going. That's it. Get in the habit of placing cash flows on a timeline. When you work in Excel, it's almost automatically does that for you, but it's a great tool to emphasize the point that money arrived at different points in time has a different time unit and cannot be added, right? Don't add money at different points in time. Let me say it one more time. Never add money received at different points in time. Now I put a little asterisk there because some people will say, well, what if the money arrives very close in time? Then it's not such a sin, but get in the habit of just not doing it. And I say it multiple times because you'll do it, your friends will do it, people in finance do it all the time. But it's not a good thing to do, and you'll see why in just a moment. What we need an exchange rate for time to convert to a common time unit, and that exchange rate is called a discount factor. Our discount factor is given by 1 plus r raised to the power t. T, that's just the number of the time periods into the future, if t is greater than 0, or past, if t is less than 0, that we want to move the cash flows. R, well, that gets its own slide. R is the rate of return offered by investment alternatives in the capital markets of equivalent risk. And that's a mouthful. R goes by several other names. It goes by a discount rate, a hurdle rate, an opportunity cost of capital. The way to think about R is just to ask yourself, what are the risks, or how risky are the cash flows that I'm going to be discounting here? And then think about how that relates to investments in the capital markets. So what I've done here is I've presented average annual returns to six different investments. And what do you see? What do you notice? You notice that riskier investments, as I move down the columns, riskier investments are met with higher returns. Riskier investment, higher return. So how do we use the tools? Well, we're first going to focus on bringing cash flows back in time, And when we move cash flows back in time, that's called discounting. And so here's my timeline that we started out with. And I'm simply illustrating that if I want to convert all of these cash flows from period 1 forward into time 0 units, what I do is I apply my discount factor, right, to each one. So to move cash flow 1 back to period 0, I'm going to multiply by 1 plus r to the minus 1 because I'm moving it back in time, hence it's negative, 1 period, hence 1. And similarly for cash flows 2, 3, and 4. Right? Again, notice that all of the exponents are negative because we're moving all of these cash flows back in time to today's units. Right? Once I've done that, once I've discounted each cash flow back to today, I can add all of these numbers. Right? They're all in the same time units, namely date 0 units. Let's get rid of this mess. These values of the future cash flows as of today are called present values. Present values of cash flows is the discounted value of the cash flow as of period t, or in this case, period 0. And the notation is just that. Present value as of period 0 of cash flow 1. Present value as of period 0 of cash flow 2. It's just some notation that'll be useful as we move throughout the course. Let's do an example. How much money do you have to save today to withdraw $100 at the end of each of the next 4 years if you can earn 5% per annum? The first step in tackling any problem is to just put the cash flows on a timeline. Let's get our bearings straight, right? The question is, how much do I need today? So how much do I need today, period 0, if I'm going to withdraw $100 each year over the next 4 years thereafter? Okay? Well, the naive thing to do would be to just add these and say $400. But we know that's wrong because that's a no-no. These cash flows or these dollar amounts have different time units. We can't add them. What we need to do is move them back in time today by discounting. And since we've assumed a 5% discount rate or a 5% rate of return on our investment, that's our R. And you'll notice I'm dividing each one by the discount raised to the appropriate power. We can do a little arithmetic, and now I can add all of these numbers. They're all in the same time units to answer the question. We're going to need $354.60. More precisely, we need $354.60 today in an account earning 5% each year so that we can withdraw $100 at the end of each of the next 4 years. Alternatively, the present value of $100 received at the end of the next 4 years is $354.60 when the discount rate is 5%. Now, I know that's just another way of saying what I said in one, but get in the habit of different words meaning the same thing. Finance is just laden with jargon, and the sooner you get used to it, and the more exposure you have to it, the more comfortable you come with it. With that segue, interpretation 3 is today's price for a contract that pays $100 at the end of the next 4 years is $354.60 when the discount rate is 5%. 3 different ways to say the same thing. Okay. All right. Now, I want to mention, we're assuming that the discount rate R is constant over time. See, when I pull back each cash flow, I discount each one by the same 5%. That's a common assumption, but I want to emphasize it's still an assumption, one we're going to look at when we talk about the term structure of interest rates and yield curves later on. Okay. But what's going on in the background? How is this working? What's actually happening on a dynamic basis? Well, at time period 0, we're inserting or depositing $354.60. Okay. Then we're going to earn interest at 5% on that money, which is going to amount to $17.73. $17.73. And I'm assuming all the activity happens at the end of the period. It just makes things a little bit easier conceptually. There's nothing special about that. We can make the period shorter, which we will later on. Okay, so I earn my interest, right, which is the $354.60 times the 5%. Okay, that's going to give me a pre-withdrawal balance of the initial balance plus the interest. But notice that's just the present value of that amount. The present value of this $372.32 is just our initial withdrawal balance. That's our $354.60. I'm going to pull out $100. That's going to leave me with $272.32 after the first year. And if we continue this process for the next 3 years, 2, 3, and 4, what we see is we're going to exactly offset or exactly exhaust the funds in the account. Okay, so let's summarize what we learned today. Rule number 1, never add or subtract cash flows from different time periods. You'll want to do it, don't do it. What we need to do is recognize that money is a time unit. And in order to add money at different points in time, we need to convert that money to a common base unit using an exchange rate for time called our discount factor. We're also going to get in the habit of using a timeline to get our bearings straight, a visual representation of when money is moving in or out. And we learned about the present value of a cash flow, right? It tells us the value of future cash flow as of some time period, some earlier time period. It also tells us the price of a claim to those cash flows. And what's coming up next, we're going to go in the other direction, moving cash flows forward, in other words, compounding. Thanks for listening, and I look forward to seeing you in the next lecture. Welcome back to Corporate Finance. Last time we introduced the time value of money. We started with some intuition, we introduced the tools, namely the timeline and the discount factor, and then we showed how to move money back in time via discounting. Today, I want to go the other direction. I want to move money forward in time via a process called compounding. Let's get started. Hey everyone, welcome back to Corporate Finance. Whoa. Today we're going to be talking about compounding, but let me start off with a brief recap of what we did in the last lecture. Last time we introduced the time value of money, the concept. We started off with some intuition and showed that money has a time unit that prevents money arriving at different points in time from being aggregated or added together. Then we introduced some tools associated with the time value of money, notably the timeline, which is just a visual representation of when money is moving in or out, and the discount factor, which was our exchange rate for the time value of money. It allowed us to convert the time units on money, moving it forward or backward. And then we applied those tools to move cash flows back in time via discounting. And the big lesson was don't add cash flows with different time units, ever. Today I want to go the other direction and talk about compounding or moving cash flows forward in time. So let's get started. Okay. So compounding just refers to moving cash flows forward in time. And here's our familiar timeline. And what I'm doing is I'm taking each cash flow, CF0, 1, 2, and 3, moving them forward to period 4 via compounding. So focusing on cash flow 2, I move that forward to period 4 by taking cash flow 2, multiplying it by my discount factor raised to the power of 2, because I'm moving it 2 periods forward, and it's positive because I'm moving it forward. Okay. More generally, all of the exponents are positive, again, because we're moving all of the cash flows forward in time. Now, I can add all of these cash flows now because they're all in the same time units, namely, right, I can add all of these cash flows. They're all in date 4 time units. Now these cash flows, once they've been moved forward, are referred to as future values, right? So again, this is just notation like with present values. This is the future value as of period 4 of cash flow 3, the future value as of period 4 of cash flow 2, and likewise for cash flows 1 and 0. Let's do an example. How much money will I have after 3 years if I invest $1,000 in a savings account paying 3.5% interest per annum? Well, step 1, put down a cash line. Put down a timeline. Okay, put the cash flows on a timeline. So I'm going to invest $1,000 today, period 0, and the question's asking how much money will I have in 3 years? Well, all we're going to do is move the cash flow forward in time by compounding. I'm going to multiply by 1 plus r, where r is 3.5% in this case, and I'm moving the cash flow 3 years forward in time, so that's a positive 3 exponent on my discount factor. If we do the arithmetic, we get that the $1,000 is worth $1,108.72, or just under 72 cents. Right? And I should also mention that this is just the future value of the 1,000. In particular, it's the future value as of period 3 of the cash flow in period 0, which was $1,000. Okay. Let's do a second example. How much money will we have 4 years from today if we save $1,000 a year beginning today for the next 3 years, assuming we earn 5% per annum? Step 1, put the cash flows on a timeline. That's exactly right. So we're saving $100 a year beginning today for the next 3 years. We're going to earn 5%, and I want to know how much I have after 4 years. Well, to do that, we're going to have to move each cash flow forward in time to period 4. So look at the cash flow in period 3. I need to move that forward 1 period, so I multiply by 1 plus r raised to the positive power 1. We're going forward 1 period. Cash flow 2 has to go forward 2 periods, so we're going to multiply that by our discount factor raised to the power positive 2. And likewise for cash flow the cash flows in period 0 today and 1 year from today. If we do the arithmetic, we get these future values of the cash flows, right? 105, 110, 115, 121. We can now add all of these cash flows because they're all in the same time for period 4 time units. Okay? And if we do that, I get 452.564. So what does this mean? How do we interpret that? Well, we will have $452.56 at the end of 4 years if we save $100 starting today for the next 3 years and our money earns 5% per annum. Interpretation 2. The future value 4 years from today of saving $100 starting today for the next 3 years at 5% per annum is $452.56. Okay. So what's going on here? What's going on behind the scenes? Well, we're going to deposit $100 today. That's going to earn 5% interest and give us an additional $5 at the end of year 1. So our pre-deposit balance, that's before our next deposit, is just $105, which, by the way, is also equal to the future value 1 period hence of the $100, right? The future value of this $100 1 period hence is just the 100 times the 1 plus r to the 1. I deposit another $100, and I've got $205 after the first year. We continue this process for 4 years, and lo and behold, we're left with $452.56 at the end of the 4th year. More generally, there's nothing special about moving the cash flows to the end of the timeline or the beginning. You can move them anywhere, just as long as you're consistent. We can pick any point in time, such as period 2, and I can move cash flows 3 and 4 back in time, right? By applying a discount factor raised to a negative value, I can move the cash flows today and the cash flow 1 year from today forward in time by applying a positive exponent to the discount factor. And now these cash flows here are all in the same time 2 period units. All right, so let's summarize this up. We use compounding to move cash flows forward. We apply a discount factor with a positive exponent to move them forward in time, and that gets us future values. Okay? So what I want to see you do now is work on the problem set. Okay? And then coming up next in our next lecture, I want to talk about some useful shortcuts for present value and future value of common streams of cash flows. So thanks again for listening, and I look forward to seeing you in the next lecture. Welcome back to Corporate Finance. Last time, we talked about compounding, or the process of moving cash flows forward in time. Today, I want to present several useful shortcuts to compute the present value and future value of common streams of cash flows that we see often in practice. Let's get started. Hey everybody, welcome to our 3rd lecture on the time value of money. So last time we talked about compounding, or the process of moving cash flows forward in time, to find their future value. Whereas in our first lecture, we moved cash flows back in time via discounting to find their present value. So what I want to do today is I want to give you some useful shortcuts for computing the present value or the future value of some streams of cash flows that commonly arise in practice. So let's get started. The first thing I want to talk about is an annuity. An annuity is a finite stream of cash flows of identical magnitude and equal spacing in time. And I've highlighted key elements of this definition. So here's a timeline representing an annuity. First key aspect or feature of an annuity are cash flows of identical magnitude. These are all of these cash flows are the same number. Okay, so identical magnitude. Secondly, this is a finite stream of cash flows. It ends at some point in time. Okay, and that might seem like an unnecessary or obvious assumption, but you'll see that we'll deal with infinite cash flow streams in a little bit. And then the last assumption is that the spacing between the cash flows has to be equal. So it's always a year. We always get the cash flow after 1 year, 2 months, whatever that spacing it is, it has to be the same. And it turns out that this cash flow stream arises in a number of situations in practice. So insurance companies sell a product called an annuity, representing its cash flow stream. Home mortgages are an example of an annuity stream. Auto leases, certain bond payments, and amortizing loans are annuities. So it's actually fairly common in practice. Now, if we wanted to find the present value of these cash flows, we know how to do that, right? We can brute force it. We can take each cash flow and discount it back to today, right? So imagine I had a second cash flow. The second cash flow here, I could go CF divided by 1 plus R squared. That would bring it back to today. I could take this cash flow, CF over 1 plus R to the T minus 1. That would bring it. And I do that for all the cash flows, and then I could add them up here. And that would give me the present value. But that's a bit burdensome, especially when T is big. Okay. So what I'd like to show you is a shortcut or a simple formula to compute the present value of this cash flow stream, and here it is. We take the cash flow, CF, we divide it by the discount rate and multiply it by this term in parentheses here. Now if I move the R over here, I can re-express the present value of the annuity formula as just the annuity cash flow times this term here, which is called an annuity factor. Okay? That will give me the present value of this cash flow stream. One thing to keep in mind, though, is that in order for this formula to make sense, not only do all the features defining an annuity stream have to be true, but we're assuming that the first cash flow arrives 1 period from today. So for example, if my cash flow stream looked like this is an annuity stream of cash flows, but this formula is not going to give me the present value of this cash flow stream. Actually, what I would have to do is I could just add CF, right? Because this is the present value. It's coming today. Okay. Let's do an example. How much do I have to save today to withdraw $100 at the end of each of the next 20 years if I can earn 5% per annum? Well, step one is draw a timeline. I'm trying to figure out how much I have to save today in order to pull out $100 every year over the next 20 years. Well, we know how to do that by brute force. We can simply discount all of the cash flows back into today's time units and add them up. A more elegant solution that we just learned, of course, is to apply our present value of annuity formula. Right? The cash flow is 100 CF. The discount rate R is 5%. And the time of the cash flows is 20 years. Plugging all those numbers into the formula and computing, we get the present value of these cash flows is $1,246.22. That's how much money I have to save today in order to withdraw the $100 every year. Now let's turn to something called a growing annuity, which is, as the name suggests, just like an annuity, but for the fact that the cash flows are growing. So it's a finite stream of cash flows, okay, evenly spaced through time. Okay. But now the cash flows aren't constant, they're growing at a constant rate, G. Okay. And this type of cash flow stream pops up in a number of instances in practice. Certain income streams, for example, your work, right? You might imagine that your work your salary grows at some constant rate G, or approximately some constant rate G. Certain saving strategies, maybe you want to save a certain amount each year, but you want that amount to grow with your growing income stream. In corporate finance, certain project revenue and expense streams will often grow at a near constant growth rate. So it's a really useful approximation to many cash flow streams we'll come across in practice. And like our annuity stream, we can represent the present value of this cash flow stream with a simple formula as follows. We take the cash flow as of the first period divided by the discount rate less the growth rate times this factor here. That will give us the present value of this cash flow stream right here. Okay? But remember, a critical assumption is that the first cash flow arrives one period from today. Okay? Let's do an example. How much do we have to save today to withdraw $100 at the end of this year, $102.50 next year, $105.06 the year after, and so on for the next 19 years if we can earn 5% per annum? Well, let's draw a timeline, and what we see is that our first withdrawal of $100 occurs 1 year out, then 102.5, and on and on and on. What we can discern from this problem is that these cash flows are growing at a constant rate G equal to 2.5% per annum. Okay? So this cash flow stream satisfies all of the requirements needed to use the present value of a growing annuity formula. So our first cash flow of $100, our discount rate of 5%, and here's our growth rate of 2.5%. That's going to get us a present value of $1,529.69. That's how much we would need to withdraw $100 growing at 2.5% every year. Okay. Now let's talk about a perpetuity. So perpetuity is just like an annuity, except the cash flows go on forever. Right? We get the same amount of money, equally spaced in time, forever. So where does this thing come up in practice? Well, oddly enough, it actually does in something called perpetuities or console bonds, which exist over in the UK. And interestingly enough, the formula for this cash flow stream is very simple. It's just the cash flow divided by the discount rate, CF over R. Let's do an example. How much do you have to save today to withdraw $100 at the end of each year forever if you can earn 5% per annum? Well, the timeline looks as follows, right? $100 every year forever, and clearly the brute force method of discounting each cash flow one at a time is never going to work. It's just impossible. So we have to use our formula. We take the $100 divided by the discount rate of 5%, and that gives us $2,000. We need $2,000 to be able to withdraw $100 a year forever, assuming that money can earn 5% per annum. And intuitively what's going on is once we get out 100 years, 200 years, whatever, the present value of that money is so small it's very close to zero, which is why you don't need an infinite amount of money. And the perpetuity's cousin, a growing perpetuity, is just that. It's an infinite stream of cash flow that grows at a constant rate, G, and that are evenly spaced out through time. Okay. So here's a visual representation. Here's our timeline of a growing perpetuity. What's an example of a growing perpetuity in practice? Well, dividend streams are much like a growing perpetuity. They're a useful approximation. Don't take it literally. Companies don't last forever, but we can treat them as such because there is no finite end date to most companies, absent some event such as a bankruptcy or an acquisition or a takeover, something like that. So what's the formula for a growing perpetuity? Well, it's just the cash flow that we're going to receive in the first year divided by the discount rate minus the growth rate of that cash flow. Again, we're going to have to assume that the first cash flow arrives 1 year from today to use this formula, as well as having all the other requirements being satisfied, the cash flows being evenly spaced and them growing at a constant rate. So let's do a little example now. How much do you have to save? How much do you have to save today to withdraw $100 at the end of this year, 102.5 next year, 105.06 the year after, and so on forever if we can earn 5% per annum? Well, let's draw our timeline. So we're going to get $100 here in year 1, 102.5 in year 2, that's growing at 2.5%, as is the 105.06 if I had written it here. So our G is 2.5%. The first cash flow comes 1 year from today. There's our first cash flow. This goes on forever, and the spacing is equal. So this is a growing perpetuity to which we can apply our growing perpetuity present value formula. So we take the first cash flow, $100, divide it by the difference between the discount rate and the growth rate to get $4,000. In other words, if we have $4,000 today and it's earning 5% interest per annum every year thereafter, we can pull out $100 next year and have that amount grow by 2.5% every year thereafter. All right, so let's summarize. We learned a couple of useful shortcuts today. We talked about an annuity and its present value formula. We talked about a perpetuity and its present value formula. We talked about their growing cousins, the growing annuity and the growing perpetuity and the present value formula for those guys. And while that might seem somewhat esoteric and bland or boring, we also discussed some of the applications that you might see in practice, these cash flow streams arising. Okay? And where these shortcuts are really useful, more than just finding the present value or the future value, is in finding the cash flow associated with the stream. So being able to manipulate these formulas is very important. And so in the problems, you're going to spend some time in real life contexts, or at least as close to real life as we can get, manipulating these formulas to derive certain aspects of interest, whether it's the cash flow or the amount of time or the discount rate or the growth rate. Right? So tackle the problem set. It really brings the material to life. But be very careful that applying these formulas takes care. Don't blindly apply them to any setting, because as we discussed, certain characteristics of the cash flows have to be met in order to, or certain requirements of the formula have to be met in order to use it. So good luck with the problems. Welcome back to Corporate Finance. Last time we talked about some useful shortcuts to compute the present value and future value of cash flow streams that we commonly come across in practice. Streams like perpetuities and annuities, and growing perpetuities and growing annuities. This time I want to shift gears and talk about taxes and their impact on our dollar returns. Let's get started. Hi everyone, welcome back to Corporate Finance. Last time we talked about several useful shortcuts for computing the present value of a cash flow stream. We talked about annuities and perpetuities and growing perpetuities. And we also discussed that these cash flow streams were representative of cash flow streams we might find in practice. What I want to do now is I want to shift gears and talk about taxes. In particular, I want to talk about how taxes impact our discount rate or our cost of capital, and ultimately how they impact our dollar returns. So let's get started. So I want to start with a little bit of motivation. I know we don't have a lot of time, but it's worth mentioning a few things. This is a picture of the top statutory tax rate on different sources of income, in particular dividends, which is the blue line, capital gains, which is the red line, and interest income, which is the green line. And I don't want to make too much of this picture, but I just want to emphasize a couple of things. First, you should see that the tax rates are moving all over the place. There's an enormous amount of variation in taxes over time, number one. And number two, you can see that historically, right, tax rates have gotten really high. Now, admittedly, it's not clear how many people those tax rates of 95% actually applied, but taxes are substantial and they move around a lot over time. So it's important to understand how they impact our investment income. Okay. So let's illustrate this by example. And I want to revisit an example we looked at in the past, in particular in our first lecture on discounting. So the question is, how much do you have to save today to withdraw $100 at the end of each of the next 4 years if you can earn 5% per annum? Well, recall, the first thing we do is we lay out a timeline. And here are our cash flows, right? we're going to be withdrawing $100 a year over the next 4 years, and the question's asking how much do we need today. So what we did is we discounted each cash flow, each of the $100 by the 5% discount rate to get the present value. So for example, we took this first 100 divided by 1 plus 0.05, and that got us $95.24 approximately. Then we took the second cash flow, 100 divided by 1 plus 0.05 squared, that's a 2. And that got us the second cash flow, and on, and then we could add these cash flows because they're all in the same time 0 units, and that produced our answer of 354.60. Okay. Then when we thought about what was going on in the bank account, recall, right, we would insert $354.60 into the account. It would then earn interest at 5%. We'd add that to the previous balance. Then we'd pull out some money, and that would reduce our balance. And we would continue that for 4 years. At the end of the 4 years, we would be left with nothing. Okay. All right. But now consider what happens when we have some taxes. See, now we put our $354.60 into the account. That earns interest at 5%. But now we have to pay taxes on that interest income. And I'm going to assume the tax rate we're facing is 35%, which isn't too far off from the top statutory rate currently prevailing. Okay. So that 35% of the 1773 is $621 in taxes. That's going to reduce our pre-withdrawal balance, okay, to $366.12. Then we pull out $100, and then we're left with $266.12 at the end of the first year. Okay. Which, by the way, the $266.12 is less than the $272.32 because of the taxes. Now, if we continue that process, we'll get down to 0, but only because in the last year we can only pull out $83.06. That's all we have left in that last year. Okay. All right. So on net, we're $16.94 short. The taxes are reducing the funds available for withdrawal. We're running out of money early. Right? So the lesson here is that taxes reduce the return on our investment, the dollar return on our investment. And one way to account for that is an after-tax discount rate. I'll call it RT. And that equals our usual discount rate times 1 minus the tax rate. Okay. So for our example, the discount rate R was 5%, and the tax rate T was 35% for an after-tax discount rate of 3.25%. Now let's revisit the problem using this after-tax discount rate. So now when I discount all of these cash flows back to today, I'm going to use RT, which equals 3.25%, instead of the R, which equals 5%. When we do that, when we do the arithmetic and add all these numbers up, we get 369.50, a number that's bigger than the 354.60 we originally found with the 5% discount rate. Now let's run through the exercise of looking at what happens to the savings account. So now we put in 369.50. Okay. That's going to earn interest at 5%. We're going to pay taxes on that interest at a rate of 35%, which generates a pre-withdrawal balance in the first year of $381.51. We pull out the $100, and then we're left with $281.51. We continue that process for a few more years, and at the end of 4 years, we're left with nothing in the bank account, and we've been able to pull out $100 each year. So what's the implication? Well, we need to save more to withdraw $100 per year after taxes, right? In particular, we need to save $369.50 as opposed to the $354.60. And it's also interesting to note that the difference in how much we had to save, the difference between the $369.50 and the $354.60, which equals $14.90. That equals the present value of the taxes at 5%. Check this. Discount these cash flows at 5% and see what the present value is. It should be $14.90. Okay, let's summarize this and bring it back together. Taxes reduce our dollar return. The after-tax return is less than the pre-tax return, okay? And it's less by a factor of 1 minus the tax rate that you're facing, okay? So we can discount by this after-tax return to see how much money we're going to have once we've swept out the effect of taxes. And given tax rates in the US, not to mention most of Europe and many other countries, taxes are significant and can have a huge impact on our cash flow streams, our savings behavior, and ultimately our decision making. So looking ahead, I want you to dive into the problems, work on the problem set, and then we're going to look at inflation and investigate how inflation affects our cash flow stream and our decision making. So thank you, and I look forward to seeing you in the next class. Welcome back to Corporate Finance. Last time we talked about taxes and their impact on our dollar returns. This time I want to talk about inflation and its impact on our real returns or our consumption. Let's get started. Hey everybody, welcome back to Corporate Finance. So last time we introduced taxes and we explored the impact of taxes on our cost of capital, our discount rate, and our dollar investment returns. What I want to do today is I want to think about the impact of inflation on our returns and ultimately on our decision making. So let's get started. Okay. And I want to start with a picture, as I did with taxes, to illustrate the importance of inflation. This picture shows over the last approximately 110 years inflation in the United States. And what you can see is a couple things. First of all, over the recent period, inflation has been relatively low. But if you go back beyond, say, the last 30 years, you can see periods of really high inflation, including deflation. And so what I want to emphasize is that while inflation doesn't seem particularly important these days, it can be. And if we move outside of the US and some Western European countries, inflation becomes incredibly important. So let's understand it. Okay. How does inflation impact our returns in particular? All right, so let's revisit the example we've done over the last few lectures. Right? This example, just to refresh your memory, was, how much do we have to deposit or save today in an account earning 5% if we want to withdraw $100 every year over the next 4 years? And the answer to that question was $354.60. We deposit $354.60. That earns interest at 5%. That increases our balance. We withdraw the money. That reduces our balance, and we continue over the next 3 years until we drive the account balance down to zero. Exactly. Okay. Now, the first lesson is inflation is not going to affect the money we earn. It doesn't affect the interest over here, right? We're still going to earn 5% every year, a nominal rate of return. Okay? What inflation is going to do is it's going to affect what we can buy with the money we're pulling out. Right? It's going to affect the value of that money. And so we'd like a way to quantify and understand the impact of inflation on that value. Okay. So I'm going to introduce the concept of a real discount rate, and I'm going to denote it by RR. And 1 plus the real discount rate equals 1 plus the nominal discount rate divided by 1 plus the expected rate of inflation, which I've denoted by pi. Okay. And a commonly used approximation that you'll see, though I'll emphasize this is an approximation, is that the real rate equals the nominal rate minus the expected rate of inflation. So in our example, we might have, right, our discount rate was 5%, and if expected inflation is 2.5%, which is approximately what it's been over the recent history in the US, we get a real rate of return on our investment of 2.44%. substantially lower. Now, that's important because even though the inflation is not impacting our account balance, how much money, how many dollars we have, it is impacting what we can do with that money, what we can buy with it. And that's ultimately what we care about it. So let's try discounting our cash flows now by the real rate of return, RR, which we just showed was equal to 2.44%, right? And the discounting proceeds mechanically in the exact same way as it was before, only now I'm using the real rate instead of the nominal rate. Okay? And if we do a little bit of arithmetic, we get the present values of all of these future cash flows, we add them up, and we get a value of 376.75. That's the present value of the sum of all these cash flows. Now, taxes affect dollars, but inflation does not affect dollars. It affects consumption. So we earn a nominal return, but we can't buy as much with it. Right? Let me illustrate this. Okay. So let's insert here into our savings account the 376.75 that we just computed using the real discount rate, and see what happens when we're withdrawing $100 every year. Well, that money is going to earn interest at 5%, okay, every year. Okay. We pull out $100, and what's going to happen is we're going to be left with this surplus. But that makes sense, right? Because inflation doesn't affect the dollars. It affects what we can do with these things that we pull out. Okay? See, we have extra money here. So what we really want to do to address inflation is we want to increase how much we pull out every year. Right? I don't want to pull out just $100 each year because prices are going up. So that $100, say here in year 2, can't buy as much food or housing or clothes or whatever we need to buy. Right? So let's think about what kind of cash flow stream we might want to address inflation. Okay. And one way to do that is to simply solve for the cash flows that we want to withdraw each year given a nominal discount rate R of 5%. What is CF? Okay. Well, we can solve this. This is just elementary algebra, right? Okay. And we want to use the nominal rate here since that's reflecting the dollars that we're earning. So solving this for CF, or cash flow, we get 106.25, which is greater than the 100. That makes sense. We're putting in more money at the beginning, right? Remember, originally I think we were putting in 354.60, if I remember correctly. So that we put in more, which means we can take out more than we used to take out. Right? And let's see what happens now. So we put in the 376.75. Now we're going to withdraw 106.25 each year. And we see that we're going to drive the account balance exactly to 0 with nothing left over. But ideally, we want our withdrawals to increase each year to accommodate inflation, right? I want these withdrawals to go up every year to account for the increase in prices of the goods that I'm going to purchase, goods and services that I'm going to purchase with that money. So let's think about this. Well, if prices are going up at 2.5% per year, that means what I could buy with $100 today, I'm going to need $102.50 next year because prices went up by 2.5%. They're going to go up by 2.5% again, so I'll need a little bit more, and a little bit more, and a little bit more each year. Right? See, what this sequence of withdrawals maintains our purchasing power. We'll be able to buy the same amount of food, the same amount of housing, go on the same vacations, assuming the prices are all going up by 2.5%, the expected rate of inflation. Okay? Now, these are all nominal values corresponding to the real $100 of purchasing power. And so if we take the present value of these nominal dollars at the nominal discount rate, we get the 376.75. We discount nominal cash flows by the nominal rate. Keep that in mind. It's important to emphasize that. The present value of nominal cash flows at the nominal discount rate, that's going to equal the present value of the real cash flows at the real rate, right? Remember that when we were withdrawing $100 each year, but we discounted these at the real rate of return, which I think was 2.44%, right? We got 376.75. And all that's going on is that the inflation term in the numerator and denominator of the real computation is they're canceling one another. Okay, so let's go back to our savings account. We insert the 376.75. We're now going to withdraw money that's growing at a rate of 2.5% per year to keep up with inflation, but our money in the account is earning the nominal rate of return of 5%. And what happens is we exactly exhaust our funds at the end of 4 years. And we've been able to do so by increasing our withdrawals each year to keep up with inflation. So let's summarize this. Inflation does not affect dollar returns. It's not affecting the money in the bank account or the rate at which it's growing. What it's affecting is the purchasing power of that money. So when I pull it out and go buy something, I can buy less of that good or that service with that same dollar year after year after year when we face inflation. So we introduced the idea of a real rate of return that takes into account the effects of inflation. Next time, we're going to turn to a new topic, interest rates. And we're going to build on what we've already learned to understand how to discount and value cash flow streams that don't happen every year, that are irregular in their timing, and how to deal with different compounding periods as opposed to annual compounding, which is what we've implicitly been doing all along thus far. So I look forward to seeing you next time. Thanks. Welcome back to Corporate Finance. Today we're going to turn to a new topic, interest rates, but before doing so, I want to briefly review our last topic, the time value of money. As you'll recall, we started off with some intuition, then we introduced the tools associated with the time value of money, namely the discount factor and the timeline. Then we applied those tools to move money back in time via discounting and forward in time via compounding. We discussed some useful shortcuts to compute the present value and the future value of cash flow streams that we commonly come across in practice, streams like an annuity and a perpetuity. And then we closed out the topic by talking about taxes and inflation and their impact on our dollar returns and our ability to consume goods and services. In this topic, interest rates, I want to start off by talking about interest rate quoting conventions, and I want to talk about how to compute the present value and future value of streams of cash flows when they arrive at irregular times, non-annual, and when the compounding is non-annual as well. So let's get started. Hi everyone, welcome back to Corporate Finance. Today we're going to be turning to a new topic, interest rates. But before doing so, I want to briefly review our first topic, time value of money. So we started off that topic by introducing the concept with some intuition. And what we did is we showed that cash or money received or paid at different points in time has a different time unit and as such can't be added, much like different currencies can't be added. Then we introduced the tools associated with the time value of money, namely a timeline, which is just a visual representation of when money is coming or going, and a discount factor, which is our exchange rate for time. It's what we used to move cash flows forward and backward in time. Then we use those tools to discount cash flows, that is, move them back in time, and compound cash flows, or move them forward in time. We introduced some useful shortcuts, namely the present value of an annuity formula and the present value of a perpetuity formula, as well as formulas for the present value of a growing annuity and a growing perpetuity. Then we closed off the topic with a discussion of taxes and inflation and investigated how those two concepts would impact both our dollar return and the purchasing power of those dollars. Now I want to turn to interest rates in this lecture, and this isn't so much a new topic as much as it is really an extension of the time value of money to incorporate institutional details and make things a little bit more realistic. So we're going to talk about interest rate quotes, and we're going to learn how to deal with cash flows that don't arrive once a year, but maybe arrive monthly or semi-annually. And we're also going to discuss how to deal with compounding of interest when it's not just annual. So let's get started. So here's a snapshot from December of 2014 of rates on 5-year jumbo CDs, where CD just stands for Certificate of Deposit. It's a savings vehicle that most banks offer, and here's 1, 2, 3, 4 banks. All right. Now, the jumbo, that just refers to, I think, a minimum deposit of $100,000. So these are big deposits. And one of the things you notice when looking at these rates, when you're looking at these savings vehicles, is that each one has two different rates. It has a rate and an APY, and these numbers, 2.37, 2.4, they're different. So that begs the question is, why are they different? How are they related? And most importantly, which one is going to tell me how much money I'm going to make when I invest in this product? Well, let's go through this, starting with the rate. The rate refers to the APR, the annual percentage rate. That measures the amount of simple interest earned in a year. Simple interest is just the interest earned without compounding, ignoring compounding. And if you're wondering what compounding is, we're going to talk about it. But just as a preview, notice underneath rate, we have compounded daily. Okay. Simple interest ignores that compounding frequency. Okay. Now, many banks quote interest rates in terms of an APR. The problem is the APR is typically not what we're going to earn or what we're going to pay. For that, we have to turn to the APY, or the annual percentage yield, which is really just another way of saying EAR, or effective annual rate. See, the EAR, that measures the actual amount of interest earned or paid in a year. That's what we care about, the EAR. That's the number we care about. The rate, or the APR, that's just a quoting convention. Now, how are these different rates related? Well, before showing you the explicit mathematics, which frankly are almost trivial, let me emphasize the following. The EAR is a discount rate. The EAR is what matters for computing interest and discounting cash flows. The APR is not a discount rate. It's a means to an end. It's a quoting conventions. We're going to use APRs in conjunction with compounding frequency information to get at an EAR, or at a periodic discount rate, which I'll introduce in just a moment. So remember, EAR equals discount rate. APR equals quote. Now, how do we get from one to the other? How do we move from APR to EAR, or vice versa? Well, here's that simple mathematical formula I referred to just a moment ago. The EAR is related to the APR by this equality. Okay. Well, what's going on here? K, that's just the number of compounding periods per year. So imagine we had monthly compounding. That would imply a K of 12. How about semi-annual? That would imply a K of 2. And I'm going to introduce a little bit of notation here. I is the periodic interest rate, or the periodic discount rate, and that equals APR over K. Let's do an example. So imagine we're investing $100 in a CD offering 5% APR with semi-annual compounding. How much money will we have in 1 year? Okay. Well, there's actually two ways to approach this problem, and we're going to do each in turn. The first thing we always do, is we draw a timeline. And so today, period 0, we're going to invest $100. And the question's asking how much money are we going to have in 1 year? Now, I've left this as a question mark to emphasize the fact that there are two ways to go about this. Let's go about this the first way. Go about answering this problem. Okay. The first is to work in periods. With semi-annual compounding, that means there are 2 periods per year. Since I'm interested in how much money I have after 1 year, that's after 2 periods. Okay. And these periods are every 6 months. Period 1, period 2. So if I'm going to work in periods, I better compute a periodic discount rate. That's I, which we know is APR over K, and which in this case reduces to 2.5%. In other words, I'm going to earn 2.5%. I'm going to earn 2.5% over the first 6 months. Then I'm going to earn 2.5% over the next 6 months. Erase that. Okay. So I take my initial $100 investment, I multiply it by my periodic discount rate, and after one period I've got $102.50. Then I repeat. I take that $102.50, I multiply it by my periodic discount rate to get $105 and a little over 6 cents. In other words, the future value 2 periods hence of $100 in this setting is just 100 times 1 plus I raised to the power 2. We're working in periods, so I is our discount rate, and 2 is the number of periods we're moving the money forward in time. Now let's approach the problem from the perspective of years. Now we're looking for how much money we have after 1 year. But if we're going to work in years, okay, now we need to be consistent. So after 6 months, this isn't one period, this is half a year. And because we're working in years, our discount rate isn't going to be the periodic interest rate I, it's going to be the EAR, the equivalent, or the effective annual rate, which we know from earlier is just 1 plus the periodic rate raised to the number of compounding periods per year, so 1 plus I to the K, which in this setting comes out to 5.0625%. In other words, over this entire period, I'm going to earn 5.0625%, right, which turns out to equal $105 and a little over 6 cents. That is, the future value 1 year from now of $100 is the $100 times 1 plus the EAR raised to the power 1. We're working in years, which gives me the exact same answer we got before, the $105 and 6.25 cents. So the lesson: if you discount cash flows using the EAR, then you better measure time in years. If you discount cash flows using the periodic interest rate, then you'd better measure time in periods. And the equality between the two that we just showed with our simple example is much more general and given by this straightforward proof, which I'm not going to discuss in detail, but I'll show you there if you're interested in looking at it. So just to summarize, we can work in periods, right? 1, 2, with a periodic interest rate, or we can work in years with our effective annual rate. Okay? And notice I measure everything consistently, periods versus years. Okay. So let's go back to our original example. Excuse me. We had an APR of 2.37%. We have a compounding frequency of daily, which I'm going to assume is 365 days, though you should be aware it could be 360 days or it could be 252 business days. It depends upon the convention used for that product by that institution. So these two pieces of information, the APR and K, allow me to compute the periodic rate, I, which is 0.006741%. Now that's a tiny number, but we're computing interest every single day here. Which means the effective annual rate, which equals 1 plus I to the K, or which in this case is 1 plus 0.006714% raised to 365th power, gets me to just under 2.4%. So when we round the 2.398, we get about 2.4%. All right, so let's summarize. We learned that there are two discount rates depending on what units of time we want to work with. If we want to think in terms of periods, we want to use a periodic discount rate. That's I. If we want to work in years, we want to use the EAR, the effective annual rate, which relies on cash flows measured in years. Both of these are discount rates, They'll both get us to the same goal or the same end result, but we have to be consistent in terms of how we measure time with which discount rate we use. APR, that's a quoting convention. That's a means to an end. We use APR in conjunction with the compounding frequency to get our discount rate, whether it's the EAR or the periodic interest rate or the periodic discount rate I. And we can move between the APR and I and the EAR by a couple of very simple mathematical relations that we discussed. Now, next are a bunch of great problems that I want you to dive into. And then after you're done with those, move on to the second part of interest rates, in which we're going to investigate the term structure of interest rates and talk about the yield curve. Let you know what these things mean. Thanks so much. Welcome back to Corporate Finance. Last time we talked about interest rates. In particular, we talked about how interest rates are quoted versus how interest rates are used to discount cash flows. We also talked about how to deal with cash flow streams when the cash flows arrived more than once a year or less frequently than once a year, and when the compounding frequency wasn't annual. This time I want to talk about how interest rates or discount rates can vary over time and how that relationship is captured via a term structure of interest rates and a yield curve. Let's get started. Hi everybody, welcome back to Corporate Finance and our second lecture on interest rates. So last time we introduced the topic by talking about interest rate quotes versus discount rates, and we talked about an APR, annual percentage rate, which was a means of quoting interest rates that financial institutions often use. And that's often distinct from what we care about for discounting cash flows, which is an EAR, effective annual rate, or a periodic discount rate. And we talked about how to move between these concepts or these constructs. And then we showed how to apply them to non-annual cash flows and in situations where we have non-annual compounding, say monthly, semi-annual, whatever you might have. Today I want to talk about the term structure of interest rates and the yield curve. And this lecture is a little bit different in that it's not geared towards solving problems per se, at least not directly, because that's going to take us into fixed income valuation, which is beyond the scope of this course. Rather, what it's going to do is it's going to be important to understand what these concepts are, because they're going to be used for corporate decision making later on. So let's get started. All right. Thus far, we've assumed discount rates are constant through time. They just don't change. And what do I mean by that? Well, if I look at my present value formula, right, I take my cash flows and I discount them by 1 plus the discount rate. But notice that's the same discount rate. It's the same number for every cash flow, regardless of when the cash flow arrives. Now, in reality, it seems as if interest rates vary with the term of the investment. Let me give you some examples. Here's a screenshot of home mortgage refinancing rates that I took not too long ago. And you can see that as the term of the mortgage refinancing varies, so too does the rate, or APR. And consequently, so does the EAR, the discount rate. Likewise, when I looked at fixed-term CD rates, where remember CDs are just certificates of deposits, their rates tend to vary with the term of the investment as well. And there's a lot of numbers here, so let me focus your attention here. Here we have the term of the investment, right? And here we have the APR and the EAR. Right? And you can see that as the term increases or changes, so too do the interest rate. Now, what's the point here? Well, as the term of the investment changes, quite often, but not always, quite often, the interest rate will change. And the term structure is nothing more than the relation between the investment term and the interest rate. The yield curve is just a graph of that relation. So let me show you a Treasury yield curve from July 24th, 2014. On the horizontal axis, we have the maturity of the Treasury security. So here's a 1-month T-bill, right? Here's a 30-year T-bond. Here's a 5-year T-note. Okay? So these are just different treasury securities that vary by maturity across the horizontal axis. And on the y-axis is the yield, which for the time being, and in this context, you can think of loosely as the discount rate, R. And the point is that as the maturity of the security varies, so too does the discount rate, right? In other words, when the government borrows for 30 years, it's getting or paying an interest rate just above 3%. Whereas when it's borrowing over a short horizon, say 30 days, it's paying basically zero. Now, let me come back to this notion of a yield and what a yield is. A yield, Y, is the one discount rate that when applied to the promised cash flows of the security recovered the price of the security. And that is a mouthful. So let me actually show you a little formula that you're familiar with to hopefully clarify this. See, I take the price of the security on the last slide, the price of the T-bill, the price of the T-bond, and I lay out all of the promised cash flows to the security. I discount them back and I ask, what is the discount rate such that when I discount these cash flows, I get the price? That is the yield, or yield to maturity. So to build the yield curve, that's just a matter of simply computing the yield for securities of different maturities. And so without getting into the institutional details and the semi-annual compounding and quoting conventions associated with treasuries, let me just talk conceptually. So if I want the 1 year the 1 year yield, I would just take this, say, cash flow at year 1, divide by 1 plus y1, set it equal to the current price, and solve for y. Okay. If I want the second yield, I would take the second security with maybe annual cash flows of CF1 and CF2, and I would solve for the one discount rate, Y2, let's call it, such that when I discount these cash flows, CF1 and CF2, I get the price P2. And we do that for all different maturities. And the y's that come out, y1, y2, y3, all the way down to yt, that represents the yield curve. Those are the points on the yield curve. But that's the same as computing the discount rate for securities with different maturities, hence the link between discount rates and yields. Now, there is a difference between discount rates and yields having to do with promised versus expected cash flows, but that's a little bit outside the scope of the course, so let's leave that aside for now. And in the context of treasuries, yields and expected returns are relatively close. Now, one thing I want to emphasize is that yield curves, in other words, interest rates, they move around a lot, or at least they can. And so to illustrate that fact, I've plotted 3 yield curves here. The purple one is from 2012, the blue one is from 2000, and the red one is from 1981. And you can see that the rate at which the government was borrowing has varied dramatically over time. Right? Today, for short-term loans, they're not paying any interest. The interest rate's basically zero. But back in 1981, the interest rate was around 15%. Okay? The other thing I want to point out is that the relationship between the short end of the yield curve, short-term interest rate, and the long end of the yield curve, long-term interest rates, that can vary over time as well. Here, at least in 2012, we see that the curve is upward sloping so that interest rates, short-term loans to the government, are less costly than long-term loans. Whereas back in 1981, we see that long-term interest rates were actually below shorter-term interest rates, at least over a stretch here. So it was cheaper for the government to borrow at longer rates, or for longer terms at least, at a lower interest rate. Now, this raises the question, well, what does this mean? What does the upward sloping curve in 2012 mean as opposed to the downward sloping curve in 1981?
Well, there's a lot of academic debate about that, but one popular opinion is that the slope reflects expectations of future interest rates. So when the yield curve is upward sloping as it is in 2012, this suggests that future interest rates are likely to be higher. Whereas back in 1981, this downward sloping portion, also actually in 2000 it looks slightly downward sloping as well. The downward sloping curve suggests that future interest rates are going to be lower. Treasury yield curves, what they're doing is they're graphing the relationship between interest rates on risk-free loans and loan maturity. So they have a very special meaning. When we talk about the risk-free rate, we're really talking about the interest rate or the yield on treasuries. But we can plot yield curves for a host of different securities, and that's what I've done on this next slide, is I've got 3 different yield curves. The blue curve is the yield curve for high-quality corporate debt. Right? So you can see that for, what do I mean by high quality? That's investment grade, think BBB or higher. So when high-quality or highly credit-rated firms were borrowing for, say, 29 years, it's costing them about 5% per annum. At least as of July 2014. Whereas when they're borrowing short term, say 2 years, it's a little over 1%. The green curve is the yield curve for municipal bonds, AAA rated municipal bonds as of July 2014. And then the red curve is the Treasury curve. And what's sort of interesting to note is that the yields or the cost of borrowing appears to be higher for the federal government over at least certain periods than it was for municipalities, which is strange if you think that our federal government is a much safer bet than a municipality, even a AAA rated municipality. But what's going on there is mostly a tax differential as well as some liquidity issues. Okay. All right. So what's the lesson here? Well, look, yields vary by maturity and risk. So to illustrate that point, I'm going to look at the yields on corporate bonds. And you can see as the credit rating improves from BBB to AAA, which is the best rating, okay, the yield goes down. And I know drawing the up arrow isn't helping, but the numbers are getting smaller. And they're getting smaller within each maturity bucket. Right? 1 to 2, 2 to 5, 5 to 10, 10 plus. Right? And that's a result of decreasing or credit risk. Right? These are safer bonds. These are safe. These are less safe, but still relatively safe. The other thing to notice is that within a credit rating, say AAA, the yields or the interest rates are different. Now, in this case, they're increasing, but as we showed a few slides ago, right, they don't always have to be increasing with maturity. They could be decreasing. Okay. The point is that they're different across the maturity spectrum. Now, all of these interest rates that we've discussed thus far are referred to as spot rates. And what are spot rates? They're the interest rate for a loan that's made today. Now, typically, there's a different spot rate for loans of different maturities and different risks. That's what we showed right here. These are spot rates. They vary by credit risk, and they vary by maturity. Okay. Now, what's one of the big punchlines or takeaways from all of this, aside from just general knowledge and information and understanding interest rates? Well, this present value formula that we've been working with is in many ways just an approximation, because we know interest rates vary over time. So it's really an approximation for this. Now, it's not such a bad approximation when the yield curve is flat. So when we have a yield curve, here's maturity, here's yield. When the yield curve is flat, R1, R2, R3 are the same. So these two things would be equal. The problem, let's see if I can erase some stuff here. The problem is when the yield curve is, say, upward sloping severely or even downward sloping. Now there's going to be a pretty big difference from using some sort of average discount rate R as a proxy for all of the different spot rates. Okay. So let's wrap up here. What did we talk about today? We talked about the term structure of interest rates, which captures the relation between interest rates and the investment term. Right? Loans or savings of different maturities, different terms, will often have different interest rates, and that relation is captured by the term structure. The yield curve simply graphs the term structure, right? It plots on the horizontal axis the maturity, on the vertical axis the yield or the interest rate, and that shows us the relationship between investment term and interest rate. We also learned that interest rates will vary by the risk of the investment, but we discussed that earlier on back in our first lecture. And we talked about spot rates, which are the interest rates for a loan that's made today. So, what's up next? We turn to a new topic, discounted cash flow. I look forward to seeing you then. Thanks a lot.
Welcome back to Corporate Finance. This time we're going to turn to a new topic, discounted cash flow analysis. But before doing so, I want to briefly recap our last topic, interest rates. We started off discussing interest rate quotes and how they differed from the interest rates we use to discount cash flows. We then discussed how to discount cash flow streams when the cash flows arrived at frequencies other than annual, and when the compounding of interest was something other than annual as well. We closed off the topic by discussing the term structure of interest rates and the yield curve, both of which summarize the relationship between interest rates and the term of the investment. Today we turn to discounted cash flow analysis, and I want to start the topic off by discussing how firms, or people more generally, should be making decisions. Let's get started.
Hey everybody, welcome back to Corporate Finance. Today we're going to be shifting gears to a new topic, discounted cash flow analysis. But before doing so, I want to briefly recap our last topic, interest rates. So in that topic, we started off by introducing the notion of APR and EAR and a periodic discount rate. The difference being as follows, right? APRs, or annual percentage rates, are a means to quote interest rates, whereas EAR, effective annual rate, and the periodic interest rate are actually discount rates. They're economically relevant. They're what we care about. They're what we use to discount cash flows and make decisions. Then we use those discount rates to value and assess cash flow streams that were no longer arriving on an annual basis, and to deal with the compounding of interest on a non-annual basis. Then we closed off the topic with a discussion of the term structure of interest rates, which is the relation between the interest rate and the term of the investment, or the duration of the investment. And we discussed yield curves, loosely how to construct them, what the yield means, where it comes from, and how to interpret these graphs. Now we're going to switch over to discounted cash flow analysis, and I want to start by motivating the topic and providing a little bit of background by discussing decision making. So let's get started. Let's start with a question. How should we make financial decisions? Well, a reasonable answer might be to undertake those actions that create value. Value for those affected by the decision, value for the owners of a firm, for example. But which actions create value? And well, that's a complicated question. A sort of general answer that seems reasonable would be to consider actions in which the benefits exceed the costs. But here's a little wrinkle. What if the costs and benefits arrive at different times? Well, actually, we're well equipped to deal with that wrinkle because we can compare the present value of the benefits to the present value of the costs. See, because by computing the present value, we know that the discount rate, R, will adjust both for the timing and the risk of the cash flows. So that brings us to our first lesson, which is that the NPV decision rule, that is NPV, which stands for net present value, NPV. The NPV decision rule says that we should accept all projects with a positive NPV and reject all projects with a negative NPV, where NPV is nothing more than the difference between the present value of the benefits and the present value of the costs. In other words, if the present value of the benefits is bigger than the present value of the costs, that's a good thing. That creates value, and we want to undertake that project or make that decision that leads to positive NPV. And while this formula right here looks somewhat vague and ambiguous, it's actually masking something that we're already very familiar with, and that's just discounted cash flows. NPV is nothing more than discounted cash flows, except now instead of cash flow CF, I have this F in front of all the cash flows. So it's FCF. The F simply stands for free. So these are free cash flows, but they're still just cash flows nonetheless. There's nothing special there. I'm going to formally define and discuss how to compute free cash flows in our next lecture, but for the time being, just recognize we're doing nothing new here. We're simply taking a stream of cash flows, FCF naught, FCF1 through FCFT, and we're discounting them back to today by a discount rate R to get a present value, a net present value. That's it. And so the decision rule just says if the NPV is greater than 0, accept the project. If the NPV is less than 0, reject the project. And while that seems fairly easy and straightforward, actually implementing it is quite a bit more subtle. And we're going to talk about those subtleties as we move along throughout this topic. So before moving on to some of the mechanics of a DCF analysis, I want to talk about decision making in practice briefly, because it's useful to motivate it and to understand what people in different areas of both finance and non-financial sectors are doing when they're making decisions. So the first thing I want to look at is this, or show you, is this survey evidence from a survey by John Graham and Cam Harvey, former colleagues at Duke, in which they surveyed CFOs from the Fortune 500 and other U.S. domestic firms. And they asked them, how frequently do you use capital budgeting, different capital budgeting techniques? And what you can see is that there are actually a variety of responses. I've listed 6 here, but the majority or the predominant number of responses point to net present value and internal rate of return as the most popular decision criteria that CFOs use. That's followed somewhat closely by the payback rule and to a lesser extent the discounted payback rule. And in our discussion of DCF, while NPV is going to be center stage, we're actually going to spend a fair amount of time discussing all of these decision rules because each one actually has important information for the decision-making process, though each one also has certain limitations that we need to understand. Now that's in the non-financial corporate sector. If we look at what investment bankers do when they are valuing companies in fairness opinions, you can see that the large majority of investment bankers are also relying on discounted cash flow analysis, something akin to NPV. But they're also using a host of comparables methods or relying on multiples. And while this is going to take us a little bit outside of the scope of our course, I might mention, if we have some time, how we use multiples in valuation exercises. If not, I might post some additional material. And finally, there's a recent survey by Paul Gomper, Steve Kaplan, and Vladimir Mukarliamov. I hope I'm not butchering that name too poorly. But they have a really interesting survey of private equity firms, and in which they investigate, among many things, which criterion PE investors use to evaluate an investment. And what's interesting here is the vast majority rely on internal rate of return by a wide margin over any other criterion. Okay. So let's summarize this. So we're going to move through this topic of DCF, discounted cash flow, emphasizing to a certain extent the NPV rule, because that is the optimal rule in terms of always leading you to making the decision that creates value. That said, I'm going to take a much more practical perspective to corporate decision making, or decision making more, financial decision making more broadly, and recognize that other rules are still informative. They're still useful. And so it's not surprising that we see their use by practitioners, whether it's PE, private equity investors, or investment bankers, or CFOs. They're still informative, but the important thing to keep in mind is that these other rules have certain weaknesses that we need to understand, and we need to recognize the limitations of these rules so that we can use multiple rules in conjunction to come to the best decision. So what's next? We're going to dive into how to compute free cash flows, the first stage in understanding how to execute a DCF. So I look forward to seeing you in the next lecture. Thanks so much.
Welcome back to Corporate Finance. Last time we introduced the new topic, discounted cash flow analysis, by discussing how corporations, or people more generally, should be making decisions. We discussed several different decision criteria, focusing in particular on three: the NPV rule, the IRR rule, and the payback period. We also discussed how, in practice, we should be taking a practical approach and using the relevant information from all three rules. Today, I want to talk about free cash flows, a critical element in implementing any of those decision rules. Let's get started.
Hey everybody, welcome back to Corporate Finance. Today we're going to start in on Lecture 2 of Discounted Cash Flow Analysis. But before doing so, let's do a brief recap of our last lecture. So we introduced the topic Discounted Cash Flow Analysis by discussing decision making. And we talked about several different decision rules used in practice, beginning with the NPV rule, which is nothing more than the difference between the present value of costs and the present value of benefits. And while most academics, including me, will argue that this is the best rule that you should always use, I take a practical view and recognize that other rules, such as internal rate of return and payback period, contain relevant information for decision making that, if used wisely and in recognition of their limitations, can lead to better decisions. And so that's sort of the overarching approach we're going to take to DCF, is that there are several different decision rules. We'll rely on NPV, but use what we can from other decision rules. Now, in this lecture, I want to talk about sort of the bedrock, or one of the key components of any DCF and any sort of decision making, and that's free cash flow. Specifically, what is it? So let's get started. So remember, there are two components to NPV. There are free cash flows and there's a discount rate, because NPV, as you recall from last time, is little more than just a discounted stream of cash flows. In this case, free cash flows. So recall, NPV was formally defined as follows, and we recognize that this is really nothing new. Right? This is what we've been doing all along. Okay? What I'm going to focus here is on the numerator, the free cash flows. How do we get at these free cash flows in a corporate setting, whether it's capital budgeting or valuation more broadly? How do we compute these FCFs? That's what this lecture is really about. So let's take a look. Free cash flow begins with revenue, or sales. We subtract off costs, and then we subtract off depreciation, actually depreciation and amortization, but mostly depreciation. Depreciation or amortization, both. Now you might wonder, well, first, what is depreciation? Depreciation is just a accountant's way of recognizing the loss in value, the deterioration in value of physical assets like plants and equipment. But it's sort of an accounting notion. It doesn't represent a true cash flow, right? When a plant depreciates, it's not as though money is leaving the company. So you might wonder why we're even considering it. Well, the reason we're considering it is because we're going to take this term in parentheses that I've now bracketed and multiply it times 1 minus TC. TC is the marginal tax rate. Okay. See, even though depreciation doesn't represent any dollars flowing out of the company or away from a project, it's not a literal cost in terms of dollars, what it does is it does reduce our taxable income. It provides a tax shield. And so we have to take that into account when computing free cash flows, because taxes are actual dollars leaving the company or the project. Okay. Now, this quantity here goes by several names. They're all synonyms. Unlevered net income, net operating profit after taxes, or NOPAT, or earnings before interest after taxes, EBIT. Once we have this, we're going to have to add back in depreciation. And again, that's just to net out the subtraction of depreciation here. Right? It doesn't represent a true cash flow. What it does represent is a tax shield. So we add back in the depreciation. Then we're going to subtract off, get rid of that, capital expenditures or any investments we have to make. And then finally, we're going to subtract off the change in net working capital. And that sometimes throws people for a little bit. What do you mean subtract off the change in net working capital? Well, first, what is net working capital? Well, net working capital, NWC, is equal to current, that's supposed to be a U, current assets minus current liabilities. And current assets, that's loosely cash plus accounts receivable plus inventory. Okay. And current liabilities, we're going to focus on accounts payable. Now, some of you might say, what about short-term debt or long-term debt that's coming due? That's financing. Leave that aside. That's a separate issue. We'll talk about that a little bit in a little bit. Okay. So what goes into the free cash flow calculation is not net working capital. The change is important because these are all what economists call stock variables, and we're trying to compute flows. So we want to look at the change, the period over period change in net working capital, and subtract that from free cash flow. So what is free cash flow intuitively? Well, it's the residual cash flow that's left over after all of the project's requirements have been satisfied and the implications accounted for. It's the cash flow that can be distributed to the financial claimants of the company, debt and equity. That's another way to view it. It's not the same as accounting cash flow from the statement of cash flows, but we can derive free cash flow from the statement of cash flows, actually with just a few steps. Now, I want to be precise here. The free cash flow we're going to compute here, or is defined right here, this is unlevered free cash flow. And I say unlevered to distinguish it from free cash flow to equity or levered free cash flow, which we'll discuss on the next slide. Okay. So, free cash flow to equity starts with free cash flow, the definition of free cash flow. That's just this quantity right here. And then we've added, we've appended two terms. We're going to subtract off the after-tax interest cost and add back in any net borrowing. That is, borrowing above and beyond any repayment of debt. So another way to compactly write the free cash flow to equity is that it starts with unlevered free cash flow, the free cash flow available to debt and equity holders, and we subtract off the after-tax interest expense and add in the net borrowing. So what is free cash flow to equity? It's the residual cash flow left over after all of the project's requirements have been satisfied, implications accounted for, and all debt financing has been satisfied. That's critical. We take care of the debt holders first because they're senior claimants. Free cash flow to equity is the cash flow that can be distributed to the shareholders, i.e. equity holders of the project or the company. And free cash flow to equity, this should be E, there we go, is more precisely levered free cash flow, because free cash flow to equity is affected by the company's choice of financial structure, its leverage decision, how much debt it plans to take on. So let me show you this what we've just discussed schematically in terms of a hierarchy, that's kind of getting us a little bit close to an income statement, right? Remember, free cash flow starts with up at the top with revenue. We're going to pull out the depreciation. Well, the revenue comes in. We're going to pull out the depreciation and costs. We're going to pull out our taxes. Okay, that's going to give us our unlevered net income. This is our NOPAT or our EBAT. Then we're going to add back in the depreciation because it's a non-cash expense. And again, that could be depreciation and amortization. We're going to subtract off our capital expenditures, our investment requirements. We're going to subtract off our investment in net working capital, the change in net working capital, and that's going to give us our unlevered free cash flows. These are the cash flows that can go to debt holders and equity holders. Then we're going to subtract out our after-tax interest expense. And I say after-tax because remember, interest is tax deductible, right? It provides us a tax shield. And then we're going to add back in any net borrowing. So if the company borrows some debt in excess of what it repays, that's a cash inflow that's available for use by the equity holders. And what we're left with down here at the bottom is the levered free cash flow, or the free cash flow to the equity holders. So strategic decisions, a useful way to think about strategic versus financial decisions is that strategic decisions are going to affect the inputs to free cash flow, well, and free cash flow to equity, but they're impacting here, right? Strategic decisions are going to affect our market share and our revenue. They're going to affect our cost, our investment decisions, right? Investment decisions, our operations, inventory and the like. All of these strategic decisions are going to impact our unlevered free cash flow and ultimately our levered free cash flow. Right? Financing decisions are down here. They're going to impact our leverage choice, the after-tax interest expense, the net borrowing. Okay? And hence, that's why we refer to these cash flows here as unlevered. They're unaffected by leverage choices. Now, strictly speaking, that's not always true. In more advanced valuation courses, you might see financing decisions feeding back on some of the inputs into unlevered free cash flow, such as the ability of a firm to invest or its revenue growth. But a useful benchmark and a common benchmark is just to recognize that financing decisions do not affect the unlevered free cash flow. And that's a great way, by the way, to check your computations in any sort of valuation or DCF exercise. At least one way is by recognizing that financial policy is not going to hit the unlevered free cash flows. All right, so let's summarize this now. Okay. NPV is a decision rule that's going to quantify the value implications of decisions. That's what we learned last time. And there's two key components to it, right? There's free cash flows and discount rates. This lecture was all about how do we put some meat behind that FCF term? How do we actually compute it? How do we derive it for a project or a firm, more broadly speaking? And what we saw is that there's a relatively simple formula for computing free cash flows, and don't be misled by its simplicity. It applies broadly. We can always use this definition. The trick in practice is actually estimating the components and figuring out what hits unlevered free cash flow versus levered free cash flow, what's relevant for cash flow, what's not relevant for cash flow. And the remainder of this topic is going to be geared towards answering those questions in the context of an actual example. So coming up next, we're going to start in on forecast drivers, or trying to understand how we're going to forecast each of those components of free cash flow out into the future. Thanks so much.
Welcome back to Corporate Finance. Last time we introduced free cash flow. We talked conceptually about how to compute free cash flow. Today what I want to do is I want to introduce a capital budgeting application to illustrate discounted cash flow analysis, and in particular what I want to do is emphasize the role of forecast drivers, or the assumptions we need to forecast free cash flows out into the future. Let's get started.
Hey everybody, welcome back to Corporate Finance and our third lecture on the DCF topic, forecast drivers. Let me start with a brief recap of what we talked about in our last lecture, which was free cash flow. In that lecture, we talked about what free cash flow is, how to compute it. We formalized it. We actually gave it a specific formula. We also talked about free cash flow to equity, the levered counterpart to free cash flow, or more precisely, unlevered free cash flow. And what I want to do in this lecture is talk about forecast drivers, or the assumptions required to forecast each component of the free cash flow formula out into the future. And we're going to do it by way of a specific example. So let's get started. So imagine we're a company in, say, 2008, and we're considering building and selling a tablet. And so back in 2008, this was really just the start of the tablet market. So I've put our free cash flow formula up here to highlight the components that we're going to need. And remember, the question is, should we enter this market? Should we produce and sell this tablet? Well, to make that decision, what we're going to want to do is a DCF, and we're going to want to forecast each component of this free cash flow formula into the future. So let's do that. We're going to start with revenue. So revenue is market size, how big the market is in terms of units, times market share, what proportion of the market we're going to capture, times our price per unit. So let's look at our forecasts here. So I'll start with the market size. Okay, now I'm going to assume that in the first year the market size is going to be 1 million units. That's going to be the early adopters, the techies, the people who are really excited about new technology and the introduction of new technology. So that's going to be 1 million units in year one, but that's then going to grow quickly in subsequent years. And you might say 2,500%, that's ridiculous. And it's an absolutely enormous growth rate for sure. But remember, this is the beginning of a new market that we're anticipating will take off in a big way. All right, so 2,500% in the second year, followed by 128, 9.4, and 3.5%. Now you might wonder, where in the world am I getting these? Well, I'm getting them from a variety of different sources. I'm getting them from my marketing people and my strategy group within the company. I'm getting them from industry analysts as well. So there's a host of different sources of input that go into these numbers, but at the end of the day, they are just assumptions, and I'm going to emphasize that fact later on. So I can use these two assumptions about the market to compute a market size in terms of millions of unit, right? Just 1 million in the first year. That's going to grow by 2,500%, 128, 9.4, 3.5. So that's my forecast for the size of the tablet market. Now what's interesting, what I'm going to show you in this next slide, is here is the actual market size for tablets. And what you can see, even with a 2,500% growth rate, I was conservative in my estimate, right? 26 million as opposed to 60 million in sales in the second year, followed by 116, 195, 229. So not sales, the actual size of the market. So you can see this market took off incredibly rapidly. Right. Next, I want to look at my market share. I'm going to assume an initial penetration of 25%, followed by annual growth of 5% each year thereafter. That's going to allow me to forecast my market share, which I bring down to 25%. That's going to grow at 5%, 5%, 5%, and 5%. So this is, just to be clear, 25% times 1 plus 5%. That'll get you the 26.3%. And likewise for the subsequent forecasts. And finally, we have to come up with a pricing strategy. I'm going to price our tablet initially in year one at $200 per unit, which I just bring down here. I'm not going to experience any price change in the second year, but then I'm going to increase prices in the third year by just under $50. Now you might wonder, what am I thinking? Consumer electronics prices go down and go down fairly rapidly. But what I'm going to do is I'm going to build in some element of versioning here. So just like we had the iPad, iPad 2, iPad Air, I plan on doing some R&D, which I'll discuss later, that's going to develop new, better versions, lighter, more powerful, better screens, etc. So that's going to justify an increasing unit price over time. Let's move on to costs. So I'm going to start with COGS, or costs of goods sold, which I express as a margin here, or a percentage of sales. And I'm going to assume that's going to run at about 80.66%, a number based on our company's experience working in the computer industry for some time, based on estimates from our operations people and insights from other analysts and consultants. Okay. My SG&A, sales, general, and administrative expenses, are going to run at about 1% of my current SG&A, or $69.59 million. I'm just making that number up, bear with me. Okay. So it's going to be $69.59 million in the first year, and I'm going to assume that's actually going to grow by 25% per year, because hopefully as sales and the size of this market grows, I'm going to have more overhead to keep up with that growth. Whereas I'm tying COGS, which is loosely viewed as a variable cost, I'm tying that forecast to sales. Okay. Now, R&D, well, I'm going to have to spend $200 million up front in R&D to get this thing up and running. Right? And then I'm going to have an additional 25, so that's this upfront R&D. Then I'm going to have an additional $25 million every year thereafter to deal with versioning and improvements. Now let's turn to our investment needs. I'm going to assume an upfront investment of $227.7 million to build a plant, get any necessary equipment for production. My first year investment is going to be 10% of that initial investment, and then subsequent years are going to be annual growth of 5%, and then 1, 1, and 1. Okay? And you'll see how this rolls out in the next lecture when we actually forecast those free cash flows. Okay? But these are just the assumptions. We're laying the groundwork here. Now, at the end of this project, which is 5 years, right? So I'm going to assume, assuming that this is a 5-year project. At the end of this project, I'm going to have all of this plant, property, and equipment left over. Well, let's focus on the plant and equipment. It's going to be there. It's not going to just disappear at the end of the project. So I'm going to assume I can do something with it. I could sell it. I could rent it out. I could redeploy it for another product. But I'm going to take a step back from precisely what I do with it and just assume a liquidation value or a valuation for it that in which I get 50 cents on the dollar. Okay. It's just an assumption. Now, for depreciation purposes, I'm going to assume that all capital depreciates on a straight line over 5 years. That is, its useful economic life is 5 years. And so each year, 1/5 of the capital theoretically disappears. Again, that's a non-cash expense. It's not costing me anything, but it is going to provide a tax shield here that we have to recognize. So we need to understand what our depreciation is going to be. Now, on to net working capital. Recall, net working capital is cash plus inventory plus accounts receivable minus accounts payable. Accounts receivable, accounts payable. Okay. Let's go after each component here. I'm going to assume this project is going to require a certain amount of cash, which might seem a little bit odd, but think of it as cash that I need to pay employees and ongoing bills such as utility costs, IT expenses, whatever it may be. And those requirements are going to be defined by 50% of my SG&A and 100% of my anticipated R&D expenditures. Let's clear that. There we go. My inventory forecast is based on inventory days or turnover. How long does it take to get inventory in and then out? I'm going to assume that that's 7.58 days, which, by the way, is very fast. You have to look to a company like Dell for that kind of turnover. And finally, I want to recognize that at the end of this, I'm going to have some inventory left over, which I assume I can get 25 cents on the dollar. At that point, it's going to be fairly obsolete. I might want to scrap it. I might want to sell it on some secondary market. Sorry about that. Some secondary market. So I'm going to assume 25 cents on the dollar for that remaining inventory at the end of this project. Okay. My accounts receivable are based on days receivable, or how many days it's going to take until I actually get some money in following a sale, because remember, a lot of sales are based on credit. And likewise, my accounts payable are based on days payable, which is going to tell me roughly how long it takes for me to pay my suppliers. You know, I might be paying them using trade credit. Okay, so that's our working capital, but remember, what we want is the change in net working capital. So while these forecasts here, all of these forecasts here will get me my net working capital, what I'm going to want to look at in free cash flow is the year-on-year change from year T minus 1 to year T. And then the last piece of this puzzle is taxes. Right? I want the marginal tax rate. I want the tax rate on an additional dollar of earnings. I'm going to assume that's 25.5%. Okay. A lot of people will estimate this with an effective tax rate, that is, looking at the income statement, tax expense over pre-tax income. That's not, strictly speaking, what we want. To get at the marginal tax rate, you probably need access to the tax records of the company, which are difficult, if not impossible, to get. So a lot of people will also assume a top statutory corporate tax rate of around 35, 36%. Okay. All right, so what we've done is we've gone through, let me just wrap up a little bit here. We've gone through and we've produced or made assumptions about every component in our free cash flow formula. And all of those assumptions are going to allow us to forecast dollar values into the future. Okay. But let's take a step back. This is nonsense. That's a common look I get from students or practitioners when I discuss this framework, because the argument is, look, this is impossible to make accurate forecasts in the future. It's hard enough to figure out what our company is going to do and how the economy is going to change and how that's going to impact our company a quarter out, much less 5 years. And I agree, but I think that's not the point. Let me be clear on what I agree. It's not that this is nonsense, but I do agree that it's very difficult, if not impossible, to make accurate forecasts. But that's not the point. That is just not the point of a DCF. The point of a DCF is really to focus the discussion and analysis on the relevant issues, to get away from decision making based on gut feelings, what the stars look like, whether it's a full moon, other ad hoc rules of thumb, just referring to nebulous experience and I know best, or I've been at the company for 20 years, this is the way it is. DCF provides a rigorous framework within which we can discuss what really matters for value creation. And that's the whole point. That's what I want to emphasize. The goal of a DCF isn't to get one number that we argue is correct. The goal of a DCF is actually to provide a host of numbers and a host of sensible and financially correct information from which we can make better decisions. And I'm going to emphasize that throughout. Another lesson I want to emphasize here is that no successful valuation or DCF can rely solely upon input from financial personnel. It's critical that we get input and insights from all aspects of the company or across division lines. I mean, think about what we're forecasting. We're forecasting revenues, what's going on with the market. So we want to talk to our marketing and strategy people. We're going to be talking about investments and operations. We need to understand what our inventory is going to be from our operations people, from line managers, even from lower rank and file employees. That's how you build a successful valuation. That's how you build a successful DCF model with really good inputs from knowledgeable people. All right, let's wrap this thing up. So today we discussed forecast drivers in the context of a specific example, that being a tablet. And these are nothing more than the assumptions that we're going to use to forecast the dollar values of each component of our free cash flow formula. And again, the goal isn't to get the right answer, it's to provide that framework within which we can discuss sensibly and logically the relevant issues for making decisions. So in the next lecture, what I want to do is I actually want to use these forecast drivers to forecast the free cash flows, the dollar values. I look forward to seeing you then.
Welcome back to Corporate Finance. Last time we talked about forecast drivers, or the assumptions required to forecast free cash flows into the future. Today, I want to apply the forecast drivers we discussed last time in the context of our tablet case and apply them to the free cash flow formula to forecast free cash flows into the future for the tablet project. Let's get started.
Hey everyone, welcome back to Corporate Finance. Today we're going to be talking about forecasting free cash flows, but before doing so, let's start with our recap of the last lecture. Last time we laid out our forecast drivers, and those were the assumptions that are necessary to generate our free cash flow forecasts. In particular, they're the assumptions about each of the components going into our free cash flow formula. Today, I want to apply those forecast drivers to actually forecast dollar cash flows, dollar free cash flows over the 5-year horizon for our tablet project. So let's get started. So here's our free cash flow formula. And again, the goal today is to translate the forecast drivers into dollar forecasts. So as a brief reminder, here are our revenue forecast drivers. We're going to start by forecasting the dollar revenues. Okay. And we know that revenue equals market size times market share times price. Okay. So for year one, our revenue forecast is just going to be the year one initial market size, 1 million units, times our share. We're going to get 25% of that market. And then we're going to multiply it by our per unit price of $200 for a revenue forecast in year one of $50 million. If we repeat that process for years 2 through 5, we'll get our revenue forecasts for all 5 years. And there they are. Now let's move on to costs. And we'll start with COGS, cost of goods sold. You can see that our forecast drivers here are expressed as a percentage, and in particular a percentage of sales. So I'm going to repeat the sales forecast from the last slide here because we're going to need them to get at COGS forecasts. So if we look at year one, we can see that 80.66% of the sales are assumed to be cost of goods sold. So we take our $50 million revenue forecast, multiply it times that 80.66%, and out pops an estimate or a projection of cost of goods sold in the first year of $40.33 million. If we repeat that process through years 2 through 5, we're going to get a full-blown COGS forecast over the entire projection period. Now let's move on to SG&A, still in the costs category. Here we've assumed a first-year SG&A expense of $69.59 million. Now it's in dollars already, so there's not really anything to do. It was just an assumption I made based on 1% of the 2008 company-wide SG&A expense, a number I essentially made up just for illustrative purposes. But going forward in years 2 through 5, we're going to assume that SG&A expense grows at 25% per annum. So to get year 2, for example, we start with our $69.59 million expense in year one, and we compound it up by 25% to get an estimate of $87 million for our second year SG&A expense. And if we continue with that 25% annual growth, we're going to get an actual SG&A series here. Finally, moving on to R&D, there's really not much to do here because I've assumed dollar forecasts both for the upfront R&D necessary to get the project off the ground, as well as the subsequent R&D required for any versioning. So here are our R&D dollar forecasts. I'm going to take a step back and put this together into a somewhat familiar format, and we're going to start with the top line sales forecasts right here. I'm going to subtract off my COGS to get at gross profit. I'm then going to subtract off my SG&A expenses and my R&D expenses to get estimates of EBITDA. And EBITDA is a mouthful once you say it. It's earnings before interest, taxes, depreciation, I'll abbreviate that, and amortization. Okay. Now let's move on to capital expenditures. So our upfront investment is going to be $227 million, well, a little over $227 million for the plant and the equipment. Then we're going to invest in the first year of the project 10% of that amount, followed by annual growth of 5%, 1%, 1%, and 1%. So, to get our dollar forecast, there's nothing to do for year zero. That's just the $227 million. For year one, we're going to take 10% of that $227 million to get $22.77 million. And then for let me clean that up a little bit. For year two, we're going to grow that at an assumed 5%. So we compound up the $22.77 million at 5% to get an estimate or a forecast of capital expenditures in year two of $23.9 million. And continuing that growth process for years 3, 4, and 5, okay, right, at 1%, we're ultimately going to arrive at our projected capital expenditure series. There it is. Now, we're going to assume we're going to straight line depreciate this capital expenditures over 5 years. What that means is 1/5 of the capital stock is going to depreciate each year. All right, so what I'm going to do to make things a little bit easier is I'm going to create a row of accumulated capital expenditures, right? So that's nothing more than the current plus all previous capital expenditures. So this 250.5 is the 227 plus the 22.8. The 274.4 is the 250.5 plus the 23.9, and on and on and on. And the reason I'm doing that is to avoid keeping track of different vintages of capital stock, since they all face the same depreciation schedule, at least by assumption. And what I can do to compute the depreciation is simply divide last year's accumulated capital expenditures by 5. So the 45.5 in year one comes from 227 divided by 5. Year 2, 50.1 comes from the 250.5 divided by 5. And again, all we're doing is, what's really going on is this capital stock is depreciating by another 20%, and then this depreciates by 20%. So we add those two to get the 50.1. And we continue that on, and we're left with, we get our depreciation series. Now, here's a question. What happens to all of this physical capital at the end of the project, at the end of the 5 years? It certainly doesn't evaporate, right? It doesn't disappear. We can sell it, or we can redeploy it in for another purpose. So we need to recognize that. Okay? Otherwise, we're going to underestimate cash flows. Okay. So what I'm going to do is I'm going to take that, all of that capital expenditure, that accumulated capital expenditure, and I'm going to subtract from it the accumulated depreciation. That is, I'm just going to sum up all of the depreciation to get this 274.8. The difference between the accumulated CapEx and the accumulated depreciation is the book value of the assets, or $72.8 million. Okay. Now, I'm going to assume that I can't sell that on a dollar for dollar basis. Rather, I'm going to have to sell it at a discount, 50 cents on the dollar. And so the liquidation value, the money I can actually get for it, which is different from the book value, is assumed to be $36.4 million. But remember, we have to deal with taxes. And so what we're really interested in are the after-tax proceeds from selling this. So we're going to get $36.4 million, but we're going to experience a book loss because the value for which we can sell the assets, by assumption I might add, this isn't always the case, is less than the book value of the assets. I multiply that times the tax rate, so we get a little bit of a tax shield here from our loss. And the result are after-tax proceeds that are actually greater than the liquidation value. We're going to get $45.6 million. And so the end result is that we have our projected capital expenditures here, but once I factor in the after-tax proceeds from the sale of these assets, we're actually going to have a negative capital expenditure in that last year, that fifth year, which is going to reflect an inflow of money. So now let's turn to net working capital, more precisely the change in net working capital, but we'll start with net working capital, which is, you remember, is cash plus inventory plus accounts receivable minus accounts payable. And here were all of our assumptions, all of our forecast drivers for the components of net working capital. Let's start with the top, the cash requirements. We're going to require 50% of SG&A in cash and 100% of our R&D expenditures. So we're going to need our SG&A forecasts and our R&D forecasts to back out the cash requirements. Notably, for year one, we're going to need 50% of our SG&A expenditures, or $34.8 million, held in cash. But we're also going to need 100% of our R&D expenditures, 100% of the $25 million, or $25 million. We're also going to need to hold that in cash. Right? So our cash requirements are the sum of these two and are given by this row. And again, we're just going to repeat that, year by year for 2, 3, and 4. Turning to inventory, our forecast drivers lay out the days, the inventory days, but the inventory days are based on COGS, so I'm also going to need my COGS series, which I've put here for convenience. So to compute the first year inventory requirements, I'm going to take my days in inventory, 7.58. I'm going to multiply that by my COGS expenses, and I'm going to divide that by 365 to get an estimate of first year COGS at $837,000. If I keep doing that year after year, we'll get our inventory requirements. Turning to accounts receivable, we've got days receivable assumptions. Those are based on sales, so here's my sales, forecasted sales. When I apply the days receivable to the sales, say for year one, for example, I've got 38.49 days receivable times the $50 million sales forecast divided by 365 days, gets me a forecasted or projected accounts receivable of $5.2 million, a little over $5.2 million at the end of year one. We continue that process for years 2 through 5. And there's our accounts receivables projections. And finally, we turn to accounts payable. I've got days payable assumptions of 61.54 days. This is based on COGS, so here's my COGS series for convenience. I apply my days payable forecast to our forecasted COGS series, and out pops the accounts payables forecast. Okay. Repeating that process again, years 2 through 5. We get our accounts payable. Oh, there's a typo. We get our projected accounts payable series. And we can put this all together, our cash, inventory, accounts receivable, and accounts payable forecasts, to compute net working capital for each year. Remember, it's going to be cash plus inventory plus accounts receivable minus accounts payable. That gets us our net working capital. But here's a question. What happens to all this working capital here at the end of the project? Specifically, what happens to all the cash that's sitting there, or the inventory, or the accounts receivable, the customers from whom we're waiting to receive payment, or the accounts payable, the suppliers who are awaiting our payment? What happens to all that net working capital? Well, like physical assets, it doesn't just disappear. In fact, most of it is going to be recovered. Not all of it, and I'll explain why in just a second. In particular, right, we're going to be able to recover the cash. We're going to be able to recover some money from the inventory, but by assumption, back in our forecast drivers, we're assuming we're only getting 25 cents on the dollar for this inventory that is probably obsolete and either not worth much in terms of scrap or on some sort of secondary market. We're going to have to pay, we're going to have to pay all of our accounts receivable, but we're also going to have to collect, let's get rid of that. We're going to have to pay our accounts payable, and we're going to have to collect our accounts receivable. The upshot of this is we're going to recover $51.375 million in net working capital at the end of the project. Okay. So our change in net working capital, remember we're interested in the year-on-year change, is given by this row. Let's just briefly discuss it. Get rid of that guy. So the first change is 59.1 minus 0, which is 59.1. Okay. The second change is the 49.7 minus the 59.1 gets me minus 9.4. And on and on and on. And in the last year, we would have 25.6 minus the 28.2, but then we have to add back in the 51.3 to get net working capital of 48.6, which reflects recovering all that working capital at the end of the fifth year. Now, there is a bit of an assumption, well, there's a lot of assumptions, but one of the assumptions here is that we're recovering all the working capital right at the end of period 5. In reality, you're probably going to collect that within or during year 6. So I could have extended this to a 6th year, but it's not going to make too big of a difference. The discounting effect is going to be small, so I just wrap it all up in this 5th year here. Okay. We have all the pieces now, right? And what I want to do first is organize them into a useful and familiar format, what I'll call a quasi-income statement. And it's a quasi-income statement because it's missing an important item and it's applying taxes slightly differently. I'll explain that when I get there. So we start top line with sales, subtract off COGS, that gets us gross profit. We're going to subtract off our SG&A, subtract off R&D, that gets us our EBITDA. And sorry, ignore these numbers here. What they are, they're references to rows in the spreadsheet. They're just a useful way to keep track of things. We're going to pull off our depreciation. That's going to get us our EBIT. We're going to apply our tax rate to our EBIT to get our tax expense, which we subtract from EBIT to get our NOPAT. Now, I call this a quasi-income statement because what's missing here is interest. No interest. That's financing. We're after unlevered cash flow, so that's not relevant here. It's also quasi because the taxes are applied to EBIT as opposed to pre-tax income, which comes after interest. Okay. All right, so this is our NOPAT series. Let's carry that NOPAT forward up to here. Add back in depreciation, subtract off capital expenditures, and subtract off the change in net working capital to get what we're really after, or ultimately after, which are free cash flows. These are the free cash flows to the project. Now, some other things to keep in mind when you're going after free cash flows. First of all are opportunity costs, alternative uses of resources, right? They're not free. Second, project externalities, and this is a biggie. In our context, you can imagine that the tablet might cannibalize or take away sales from other product lines, maybe desktops, for example. You also want to be cognizant of spillovers. You could imagine that in the process of developing and selling this product, this tablet, we might learn something about our production process that applies to other product lines. Or it might lead us to the development of an entirely new product line. We need to recognize these externalities that are associated with this project. Sunk cost, ignore those. What do I mean by sunk cost? Well, imagine we commissioned a marketing study back in 2006, 2 years before we were valuing this project or deciding on this project. The costs associated with that marketing project as of 2008 are completely irrelevant. They're sunk. They're irrelevant for our decision making. All that matters are the costs going forward and benefits. Other non-cash items such as amortization, we have to take that into account, particularly because that generates a tax shield, but also other non-cash items like stock-based compensation, stock grants, restricted stock awards, options, employee stock options, and the like. Salvage values. We touched on this in this lecture, right? Assets don't just disappear, and neither do liabilities. So we have to take into account any salvage values or liquidation values associated with our assets. Execution risk. Look, this is a risky project, but the way we're going to capture execution risk, that is risk unique to this project, is not through the discount rate. And I'll come back to talk about that more later on in the class when we get to estimating the discount rate. But this is specific to the project, so it's got to affect the free cash flows. And the way it's going to affect that is we're going to look at expected free cash flows. That's the way to think about the numerator in the NPV calculation. And we can also capture this through sensitivity analysis by looking at different scenarios or different forecasts for free cash flows. That's going to come up in a little bit when we talk about sensitivity analysis. And one last point is, I've assumed an annual frequency here, but there's nothing special about that. We could have done this on a quarterly frequency. We could have done it on a monthly frequency, semi-annual. Take your pick. What determines the cash flow frequency is really the situation. It's project dependent and it's sector dependent. So don't think there's anything special about annual frequency. We know how to deal with non-annual frequency cash flows and discounting them, so it's not a problem at all. All right, let's summarize this. What we did in this lecture is we actually forecasted the dollar values of the free cash flows. And the way we did it is we built it up from our forecast drivers of the components within free cash flows. This is one of the two basic inputs into a DCF, the other being the discount rate. And the question now is, what do we do with these free cash flows? Well, that's the topic of our next lecture, where we take a look at decision criteria. So thanks for listening, and I look forward to seeing you in the next lecture.
Welcome back to Corporate Finance. Last time, we applied our forecast drivers to our free cash flow formula to forecast free cash flows for our tablet project. Today, I want to take those free cash flows and apply our different decision criteria to come up with decisions regarding our project. Let's get started.
Hi everyone, welcome back to Corporate Finance. Today we're going to talk about decision criteria, but before doing so, let's recap our previous lecture in which we forecasted free cash flows. Specifically, we took our forecast drivers, our assumptions about what would happen in the future, and applied them to generate dollar forecasts of all of the components of the free cash flow formula, which we then built up, aggregated into free cash flow forecasts. Today we're going to turn to what to do with those forecasts by looking at different decision criteria. So let's get started. So what do we do with our cash flows from last time? One thing we can do is we can compute the NPV. And I'm going to assume a discount rate of 12%, that is R equals 12%. And if we do that and apply it to our free cash flows that we computed in the last lecture, what we're going to see is that this project, this tablet project, has an NPV of $708.42 million. Not bad. What that means is that firm value, debt plus equity, is going to increase by $708.42 million in expectation if the project is undertaken. So from a decision-making standpoint, undertake the project. That's what the NPV rule tells us. It says accept all projects with a positive NPV, reject all projects with a negative NPV. And while this has boiled it down to one number, I want to be careful, especially when we start doing our sensitivity analysis, to recognize that we don't want to pin all our hopes to that one number. Now, another thing we can do is we can compute the internal rate of return. The internal rate of return of a project, recall, is the one discount rate such that the net present value of the project's free cash flows equals 0. We've actually already seen this when we were talking about yields. Remember, the yield is the one discount rate such that when you discount the cash flows by the yield, you get the price. But the NPV is nothing more than the price minus the present value of all the future cash flows. Okay? So IRR and yield are really one and the same. So what's the IRR for this project? Well, we write our NPV formula, we set our NPV equal to 0, and then we solve for the one discount rate such that when we discount all of our free cash flows, we get an NPV of 0. If we do that, we find that the IRR on this project is 43.7%. Well, Is that good? Is it bad? Before getting there, I just want to mention, typically we're going to need to solve this numerically unless you have figured out some amazing way to solve higher order polynomials. You can use the IRR function in Excel. I think you can use goal seek in Excel. You can try trial and error, though that's really inefficient. If you're using another software program or a financial calculator, you can do this as well. Okay. All right. So what do we do with this 43.7% IRR? Well, we're going to compare it to our cost of capital, our hurdle rate. And what we're going to do is we're going to undertake the project because the IRR is greater than the hurdle rate. Intuitively, it makes sense. And this is one of those cases where intuition actually works. It costs us 12% to raise money in the capital markets, to fund our investments, to create value. If this project generates a return of 43.7%, that's substantially larger than what it cost us to raise the funds. That sounds good. That makes sense. And so what the IRR rule says is accept all projects whose IRR is greater than R and reject all projects whose IRR is less than R, where R is our hurdle rate. Hurdle rate, cost of capital, our discount rate. Now, I do want to mention that the IRR rule is informative. It's also somewhat intuitive and appeals a lot to investors who tend to think in terms of returns, but it's got a number of shortcomings that we're going to explore in greater detail in topic 4, return on investment. Now, one picture I'd like to show you is the following. I've plotted the cost of capital on the horizontal axis and the project NPV on the vertical axis. And what the blue line shows is it shows how the NPV of the project varies as I vary the cost of capital. 2 points are worth noting. First is this point right here, which is the 12% cost of capital of the project. You'll notice that generates an NPV, as we saw earlier, of a little bit over $700 million. The second point I want to point out is this point, the point where the graph crosses the x-axis. That's the point at which the NPV is 0, which, as we know from our definition earlier, is just the IRR. That's 43.7%. Now, I think this graph is, let me clear this up a little bit, this graph is useful because from a sensitivity analysis or a robustness perspective. Look, this R is an estimate, and to be honest with you, it's typically a noisy one. What I see here is I see a really wide gap between my estimated cost of capital and the point at which this project just breaks even. So even if we disagree on the cost of capital and you're taking a more conservative view and you think it's upward, our real cost of capital is 20%, that's okay. This project is still NPV positive. It's still value accretive. And so what this gap here shows is it shows that I've got a lot of room for error, at least on the discount rate dimension. The third thing we can do with our cash flows, our free cash flows, is compute a payback period, which is the duration or the time until the cumulative free cash flows turn positive. So let's look at our project. Here are our free cash flows. I'm going to accumulate them year over year. So this negative 510.4 is just the 376.8 in year 0 plus the negative 133.6 in year 1, and on for years 2 through 5. And then I'm going to look at the cumulative free cash flows and ask, when do they turn positive? Well, they turn positive right here in year 3. So our payback period is year 3. We turn cash flow positive in year 3. Some people might say it takes 3 years to recover your investment. Is that good? Is it bad? How do we know if 3 is good? How does that help us in our decision of whether or not to undertake the project? Well, what we do is we compare it to some threshold. And so the payback period rule says accept all projects with a payback period less than the threshold, reject all projects with payback periods greater than that threshold. But it should be immediately clear that the payback rule or the payback period rule has several shortcomings, the first of which is it's ignoring the time value of money and risk of cash flows. The first sin that we learned way back at the start of the course. But fortunately, that's actually quite easy to deal with. We can compute the discounted payback period by discounting the free cash flows, right? The discounted payback period of a project is just the duration until the cumulative discounted free cash flows turn positive. And so on this slide, I've computed those discounted free cash flows using our cost of capital of 12%. And then I accumulate them and wait or count until they turn positive, which is right here in year 4. So our discounted payback period is 4, which is greater than our payback period of 3. But even using the discounted payback period, this rule has a number of shortcomings. For example, it ignores cash flows after the cutoff, and that's going to lead to myopic decision making. Let me go back a slide. What if this cash flow in year 5 was $20 billion? Well, $20,114 million. It'd be a shame, to ignore that and the implication for that, of that cash flow. So by ignoring those cash flows, you get myopic decision making. Number 2, it's not telling us the value implications of our decision, right? It's not helping us quantify the effects of any decision that we make. It's also not helpful in choosing among projects with similar payback periods. So I've got 3 projects. They all have payback periods of 4. Which one do I choose if I can only choose one? All right, so let's bring this all back together. Let's bring it full circle. So there's several decision criteria. NPV is unambiguously the best and should always be used. But I want to emphasize that others, such as the internal rate of return and payback period, or its discounted cousin, they're all informative. And the key is to understand the shortcomings of these alternative decision criteria to avoid any mistakes that feed into the ultimate decision. So what I want to turn to in our next class is sensitivity analysis, which is an integral component of any DCF. Thanks again, and I look forward to seeing you.
Welcome back to Corporate Finance. Last time, we applied our different decision criteria to our forecasted free cash flows to come up with a decision as to what to do with our tablet project. This time, I want to push those assumptions around, the forecast drivers and other assumptions, to see how robust our decision is in a process called sensitivity analysis. Let's get started.
Hey everyone, welcome back to Corporate Finance. Today we're going to be talking about decision criteria, but as always, let's start with a recap of our last lecture. So last time we talked about decision criteria. In particular, we asked, what do we do with our free cash flow? And there were several things we could do. We could compute an NPV, we could compute an IRR, or we could compute a payback period. And we talked about how to implement those decision criteria and what decision to make, and we also alluded to some of the shortcomings of those decision criteria. Today I want to turn to sensitivity analysis. In other words, having set up our DCF and having completed all the inputs, now let's push it around a little bit and just see how robust and sensitive our valuation is so we can make the most informed decision possible. So let's get started. And we're going to start with something called break-even analysis. Break-even analysis finds the parameter value that sets the NPV of the project equal to 0, holding fixed all other parameters. So let's look at our cost of capital and an initial investment forecast drivers. Right? And I've got base up here to represent a base case. We're going to look at alternative cases in just a minute. You can see our base case assumption for the cost of capital was 12%, just a little over 12%, and our initial investment was $227.7 million. The corresponding NPVs for those assumptions were 708.42. Right? It's the same. It's the base case. Okay, that's what we computed in our previous lectures. Okay. The break-even values, in other words, the value for the cost of capital such that the NPV right here is 0 is 43.72. But that should look familiar because the break-even point for the cost of capital is nothing more than the IRR. Okay. And as we discussed in the last lecture on decision criteria, you can see there's a lot of room here before this project looks bad, at least on the cost of capital dimension. For the initial investment, our initial investment would have to be closer to $1 billion before this project started to turn negative. All right. Now, how did I get these? Well, I just used GoalSeek. What I did is I set the NPV cell, for example, this cell, to 0, and I would change the input parameter. And goal seek goes around by iterating it to find the 0 value. Now, I did this for all of our inputs, and I can only show you a subset. Otherwise, things get ridiculously small. It doesn't fit well on the screen. But what I like to do when looking at the break-even estimates is gauge how much room I have, at least in a partial equilibrium notion, because remember, I'm only changing one parameter at a time, and I'm going to emphasize that again in a second. I'm going to look at how much breathing room I have until the project turns south or becomes negative NPV. And so you can see these purple arrows identify parameters for which there seems to be a fair amount of scope for error, or a large margin for error. Right? So take a look at the PPE liquidation value here. I'm assuming I'm getting 50 cents on the dollar when I liquidate all of my plant and equipment at the end of the 5 years. It would take a loss of 2,253% before this thing turned negative NPV. I'd have to be dealing with some kind of maybe nuclear waste, right? Something like that. But that's not the case here. Similarly, the initial unit price, unless we're going to price this thing at $77, just over $77 per unit, this thing is positive. This project is positive NPV. This is in contrast to some of the parameters for which there doesn't seem to be quite as much a margin for error, right? So if I look at my initial market size, I'm looking to the initial market size of 1 million units. But if there's not a lot of enthusiasm, say only a little over 500,000, this project becomes NPV negative. Again, holding all other parameters constant. So this break-even analysis, I think, is a useful tool for gauging how much room we have, one dimension at a time, before the project becomes value destructive. Okay. And I want to emphasize that this is a partial equilibrium analysis. It assumes the parameters are independent, right? I'm changing one parameter at a time, and in some cases that's an unreasonable assumption. It's not to say the break-even analysis is uninformative. It's just that we have to recognize the limitation of that analysis. Now let's turn to some comparative statics. And comparative statics are going to quantify the sensitivity of the valuation to variation in a parameter holding fixed all other parameters. So what I'm going to do is I want to look at how does valuation change parameter variation from what I'll call a worst case to a best case scenario for each parameter. And again, I'm going to focus on the cost of capital and the initial investment. And by my estimates and discussion with Treasury, right, the sort of range of estimates for my cost of capital vary from a low of 9.61, which is a best case scenario, right, very inexpensive cost of capital, to a high of 15.01%. Likewise, my ops people tell me that the initial investment is likely to be $227 million, but it could go as high as 284. It could go as low as 185, depending upon short-term variation in materials and labor, etc. Okay. Right. What I see underneath each parameter estimate is the corresponding NPV. So when I change the cost of capital to 15.01%, the NPV of the project is $594 million. When I increase the cost of the initial investment from 227 to 284, right, the NPV moves from 708, our base case, to 649.47. Okay. So I actually like to look at this table. One is to get some sense of the sensitivity of the valuation to specific to changes in specific parameters. But I also like to use it as a gut check, a reality check, to make sure that the valuation varies sensibly with variation in the parameters. If I had found that as I increased the cost of capital, that the valuation here, the numbers actually went up, I've got an error somewhere in my model. Right? Okay. So how did I get this? I just used an Excel data table. Right? So these are inputs right here. Right? So all you do is highlight the matrix. Right? The NPV of the project is here in the bottom left. The parameters are in the top row. And you choose a row input cell and enter the parameter cell. That's it. Nothing more than a data table. And I did this for all of the parameters, though I don't show you all the parameters here, and it's just useful to move through them to make sure things make sense. So if I look at initial market share, for example, right here, what I see is a worst case scenario of 15%, or our penetration is only 15%, versus an initial penetration of 35, an initial penetration of 35 in a best case scenario. And you can see that the valuations increase with our penetration, which makes sense. We're selling more units. And notice they actually increase by a lot. We're going to see that that's an important value driver. So what is the elasticity of the valuation with respect to each parameter? So it's similar to what we did, but it puts a little bit more structure on the changes in the parameter, so we can compare the sensitivity of the valuation to different parameters a little bit more sensibly. So what is the elasticity? Well, it's just defined as the percentage change in the NPV divided by the percentage change in the parameter, or delta. Remember, this is nothing more than change. The change in the NPV divided by the change in the parameter times the ratio of the parameter to the NPV. Okay. Let's look at an example. Here's my cost of capital. Okay. What I've done is I've computed a cost of capital that is 1% higher and 1% lower. And I've computed the corresponding NPVs. So to estimate the elasticity of the NPV with respect to the cost of capital, I've simply looked at the delta yellow. Get rid of that guy. Delta NPV over delta parameter, delta in the cost of capital. Okay. So I've taken this guy, 703.53, minus the 713.34. Okay. And I've divided that by the difference of 12.13 minus 11.89. Then I multiply that times the average of the two numbers. So this is really just the average of the parameter values. This is the average of the NPVs. And obviously these halves cancel one another, but I wanted to put them there to emphasize that I'm just taking the average of these 2 points. And the reason I'm doing this is because the elasticity will vary depending upon the direction in which we calculate it. Not by much, but by a little. So this is just this is one possibility, or one approach for computing it. And the elasticity I get is minus 0.69, right? So a 1% increase in the cost of capital, a 1% relative increase, I should add, in the cost of capital is associated with a 0.69% decrease in the NPV of the project. And I can do that for all of the parameters. Again, I'm just showing you a few, but you can see a couple parameters start popping out very quickly, such as the initial market size, our assumption on the market growth rate, right? Our initial market share, our assumption on cost of goods sold, right? These, again, are going to correspond pretty closely to what we saw with our break-even analysis, and they're really identifying the key value drivers, the things we should really be focused on when discussing this project. But again, like our previous analysis, break-even, and our little scenario analyses, well, not scenario, sorry, our comparative statics. Comparative statics implicitly assume parameters are independent of one another. We're varying one parameter at a time, and sometimes that just doesn't make sense. So that's going to lead us to scenario analysis. What scenario analysis is going to do is it's going to quantify the sensitivity of the valuation to variation along multiple dimensions. We can vary multiple parameters. So what I've done here, going back to that best and worst case scenario, is I said, what's the worst case scenario for all the parameters here? And the best case scenario for all the parameters. Now that's not necessarily the optimal thing to do, but it's illustrative. You might want to say, what's sort of the worst case scenario if the economy goes south? Right? How's that going to affect each parameter? It may not be the worst case for each scenario, for each parameter individually, but jointly it might correspond to some sort of bad economic state of the world. Right? Having said that, I've computed I've set up each of these scenarios, worst, best, base, and best. Okay? And I've just done a little scenario analysis. And what I find is that in the worst case scenario, this project is, over half a billion dollars negative NPV. The best case scenario is 33 billion positive NPV and relative to our base scenario. Now, I wouldn't read too much into those numbers, again, because I've taken the worst case scenario for each parameter independently, and that doesn't make a lot of sense. Again, what you want to do when you're constructing these best and worst case scenarios is think, okay, let's think about a bad economic state of the world where maybe not everything goes horrible in the project, but where some things go bad and maybe other things are good. So if it's a bad state of the world, maybe labor costs go down, right? And it becomes cheaper to build the plant. You want to think about these things and how parameters are related and what really represents a plausible best and worst case scenario. Now, how did I do this? I just used scenarios in Excel. That's one way to do it. That's how I initially did it. But that's actually really inefficient. A much better way is to set up a lookup table and a toggle that you can just switch all the parameters between. Much more efficient. So here's a question. What else can we do with sensitivity analysis? We can answer some important questions that are going to come up in discussions. Here's one, for example. Imagine strategy wants to reduce the price by $30 in order to increase the initial market penetration from 25% to 30% by their estimates. Does this make sense? Well, we can answer that question. In this table, what I've done is I've set up a little two-way table. I've got quantity, our initial market share right here, our initial penetration, and price here. So these are all prices. Here are all my market shares. Here's our base case scenario in which we're assuming 25% initial market share at a unit price of $200. And marketing's asking what's going to happen if we change these. Well, in particular, they want to lower the price by $30 from $200 to $170. And they argue that's going to increase our market share upwards of, say, 30%. Well, what does that mean from a valuation perspective? Well, if we look in this box right here, we see that the NPV is going to be somewhere between 776 million and 851 million. So what's the answer to the original question? It's a good thing, right? NPV is going to go up relative to our base. Here was our base. Marketing says drop the price. That increases penetration. And sure enough, valuations go up. So it sounds like a sensible thing to do. Marketing, on the other hand, is concerned about uncertainty surrounding the market for tablets and wants to understand if we can shed any light on that. Can we provide some information? So here's another two-way table. I've got market growth rates here. Right, market growth rates there. I've got market size assumptions here, initial market size. Okay. Right. Here's our base case, indicated by the black outline boxes. So the initial market size was going to be 1 million units, and we were assuming 2,500% growth in that next year. Okay. But what this picture shows is it shows that as that growth varies and as that market size vary, what happens to the valuation? In the cells inside are NPVs. And I've color-coded them so that green is at or better than our baseline, right? You can see our baseline is all along. I've held the baseline constant along the diagonal here, all 708.42. Yellow is positive NPV, but worse or below the base case NPV, and red is negative NPV. And so this provides some picture of how much slack we have, at least along the initial market size and market growth rate assumptions. Finally, I want to talk about simulation analysis. Okay. Simulation analysis, we're going to perform the valuation for a large number of scenarios, a whole bunch of different parameter values. And what I did is I selected 500 different scenarios. What I did is I just randomly drew parameter values from a distribution constrained by the best and worst case scenario for each parameter. And I did that 500 times. And I computed the NPV for all 500 draws. and I plotted them here in a histogram. Right? So I have here the NPV along the horizontal axis, and the y-axis is the fraction of the 500 simulated scenarios corresponding to each NPV. And this red dashed line is the 0 NPV value. And what you can see up here is 77.78% of the simulations are positive NPV, 22.2% are negative NPV. And so the takeaway is it looks like a pretty good bet. This project looks like a pretty good bet, conditional on all of the assumptions that we've made to get there. We've been able to push it around through a host of different scenarios, and this thing tends to be a positive positive NPV project, value accretive. Okay. That said, I want to emphasize that the parameters were drawn independently of one another, and that's not ideal. It's going to lead to some implausible outcomes, and it's not a particularly reasonable assumption, especially when it comes to certain parameter pairs such as price and quantity. That's just one. Ideally, you want to draw from some large multivariate distribution, but now we're moving way outside the scope of this course into a valuation exercise. What I want to do is instead emphasize the importance of simulation analysis, even small-scale simulation analysis. Say you just laid out by hand, 10, 15 different scenarios. Computing power is cheap. Compute the NPV and just look at how those NPVs look across the different scenarios. All right, so let's summarize this and bring it all back together. I really want to emphasize that no DCF is complete without a sensitivity analysis. It's really an integral component of any valuation, any sort of capital budgeting or broader valuation, I should say. It's going to help us identify where value is created or destroyed. It's going to identify the key value drivers where we should really focus our time and effort in terms of our discussions for making the decision. It's also going to help us quantify and assess our risk exposure. How much can we lose? How frequently can we lose it? And it's going to help us understand the robustness of the profitability of the project. So next time, we're going to turn to a new topic, return on investment, which is actually closely related to our decision criteria. We're really going to hone in on IRR and look at some of its strengths and weaknesses. So thanks again for listening, and I look forward to seeing you in the next lecture.
Welcome back to Corporate Finance. Today, we're going to turn to a new topic, return on investment. But before doing so, I want to briefly recap our last topic, discounted cash flow analysis. If you'll recall, we started off with a discussion of how firms, or people more generally, should be making decisions through different decision criteria. Then we talked about free cash flow, at least from a conceptual standpoint. We then discussed forecast drivers, or the assumptions required to forecast free cash flows into the future. If you'll remember, we did that in the context of a tablet. We then applied our assumptions, our forecast drivers, to our free cash flow formula to get forecasts of free cash flows for our tablet project. We then brought our decision criteria back in and applied it to the forecasted free cash flows to come to a decision of whether or not to proceed with our tablet project. And we closed out the topic with a discussion of sensitivity analysis to investigate just how robust our assumptions and decisions are. Today, I want to talk about return on investment. And in particular, what I want to discuss is the strengths and weaknesses of the internal rate of return relative to the net present value rule. So let's get started.
Hey everybody, welcome back to Corporate Finance. Today we're turning to a new topic, return on investment. But before diving in, I actually want to spend a little bit of time recapping our last topic, discounted cash flow analysis. So what we did in our DCF topic is we began by introducing decision making. We showed some evidence, looked at some survey evidence of what people in practice were doing, CFOs of non-financial companies, private equity managers, and investment bankers. And we showed that they used a number of different criteria, DCF or NPV, IRR, and payback period. Then we turned to looking at free cash flow, one of the key components of any DCF. And we talked about the components that make up free cash flow and how to aggregate them. Then we talked about forecast drivers, or the assumptions necessary to forecast each of the components of free cash flow. And we did it in the context of a capital budgeting example of a tablet. We then applied our forecast drivers to forecast out each component of free cash flow and aggregate up to get a free cash flow projection. We then looked at different decision criteria That is, we figured out what to do with those cash flows and ultimately what decision to make regarding the tablet. Specifically, we looked at NPV, IRR, and payback period. We talked about their strengths, some of their weaknesses, and then we closed out the topic with a discussion of sensitivity analysis, an integral element of any DCF. Now I really want to continue on the theme set by DCF and talk about return on an investment and really emphasize IRR versus NPV, the two most commonly used decision metrics. So let's get started. So recall that the internal rate of return of an asset is the one discount rate such that the NPV of the asset's free cash flows equals 0. So I have NPV, I have cash flow, we could have free cash flow. Don't let the convention confuse you. IRR is much broader than just free cash flow, as is cash flow. But anyway, IRR is just that one discount rate such that the NPV is equal to 0. The IRR decision rule, as you might recall, says accept all projects for which the IRR is greater than R, reject all projects for which the IRR is less than R, where R is our hurdle rate or opportunity cost of capital. Opportunity cost of capital. Okay. And the intuition was simple. If it's costing us R% to raise money to fund investment, that investment should return something at least as big, if not greater than R. Preferably greater. Okay. Now, I'm going to spend some time here talking about IRR, a little bit of motivation here, because rates of return are really popular measures used for making decisions. Remember back to the survey evidence, internal rate of return was the most popular decision criteria used by CFOs. It just edged out NPV, right? And likewise, for PE firms, private equity firms, internal rate of return is by far the dominant decision criterion used for evaluating investments. So it's really important to understand this criterion. So let's compare it to NPV, and let's do it by way of an example, shortly, I should say. So first, the IRR is going to lead to the same decision, except a reject, as the NPV rule if all negative cash flows precede all positive cash flows. So here are some examples of cash flow sequences, at least the sign of the cash flows, where the IRR and NPV rules will coincide, right? So I pay a bunch of money today, and then I get nothing but positive cash flows. I pay money for the first 3 years, right? I don't like that. Let's do this. For year 1, 2, and 3, and then years 4, 5, and on are all positive. The key is that the negatives have to come before the positives. Negative before positive. Then IRR and NPV lead to the same decision. Okay? If that pattern of cash flow signs is violated, not only may IRR and NPV rules not coincide, not lead to the same decision, but you can get some pretty wacky stuff with IRR, from multiple IRRs, in which case, which one do you choose? It's not obvious, to imaginary IRRs. and I mean mathematically imaginary IRRs. You'll get an IRR times some number times the square root of -1, which is really hard to convey to a CEO. Trust me. So let's think about whether or not we can compare projects using IRR. And here's where I want to work in the context of a specific example. Imagine Wharton wants to upgrade its IT system and overhaul its network infrastructure. So it puts out a request for proposals, an RFP, and in comes a bid from Cisco. And the Cisco bid we evaluate to generate $60 million in cost savings over 3 years for an upfront cost to Wharton, of $100 million. Now, if our cost of capital, Wharton's cost of capital, is 12%, what is our assessment of this bid? Okay. First things first, write down the cash flows. Here they are. We're going to get, right, bid 1. It's going to cost us $100 million today, then we're going to experience cost savings of $60 million for the next 3 years. Okay. We can compute, let's clear this up. We can compute the IRR by solving this equation, right? Just set the NPV for the project equal to 0 and solve for IRR, that gets us 36%. Now, because the IRR is greater than the discount rate, our hurdle rate, remember, that was 12%, and the cash flow signs are proper, that is, they follow, right, negatives followed by positives, this project looks good. Okay. If we compute the NPV, if we just discount the cash flows, future cash flows by the Wharton's cost of capital, 12%, we're going to get an NPV of $44.11 million, which is greater than 0. Well, that looks good too. So both IRR and NPV point in the same direction. This looks like a reasonable bid. Wharton's going to be better off by accepting it. But then Cisco comes back and they say, we're going to give you the same cost savings, $60 million over 3 years. But now what we're going to do, instead of charging you $100 million up front, we're going to spread the costs over time. $20 million today and then $35 million over 3 years. So let's try evaluating this bid. I mean, it sounds somewhat attractive if we can avoid that huge upfront bill. So for bid 1A, here are the costs. It's going to cost us $20 million up front as opposed to $100 million, but we're going to have to pay $35 million over the next 3 years. Okay. We still get the same cost savings, so the net cash flows for this bid are minus 20, 25, 25, and 25. Okay. Let's compute the IRR and NPV. IRR first. Well, the IRR, we set the NPV of these cash flows equal to 0, solve for the IRR, and we get, whoa, 112%. That's impressive. That is very impressive. And we see that the IRR for bid 1A, this bid, is 112% is greater, much greater. I'm going to put much greater than the bid 1, the first bid from Cisco, which had an IRR of 36%. We can also compute the NPV by just discounting by the cost of capital, 12%, Wharton's cost of capital. That gets us an NPV of $40.05 million. So bid 1 had an NPV of $44.11 million. Bid 1A has a NPV of $40.05 million, which according to the NPV rule means bid 1 is better than bid 1A. What's going on here, right? NPV says bid 1 is better, right? 44.1 is bigger than the 40.05. IRR says bid 1A is better because the 112% return is better than 36% return. What do we do? Well, let's take a closer look. That's the first thing we do. And we see, let's look. Here's bid 1. Cisco's costs are $100 million, all up front. For bid 1A, sorry, Cisco's costs. Wharton's costs are $100 million up front. Bid 1A, Wharton's costs are only $20 million up front, but then $35 million every year thereafter. And so what bid 1A is doing is it's inserting a loan. Cisco's lending us money, right? In particular, they're lending us $80 million today in exchange for $35 million over the next 3 years. Here's a question. What's the interest rate on the loan? We can figure that out, right? I can figure out what the interest rate on this loan is. How? Just compute the IRR, right? Just compute the IRR. And if we do that, we see that the interest rate is 15%. Right? And again, this is just the IRR. I want to emphasize that. Let me clean that up. It doesn't look, right, if I move this over here, this will be 0, this will and this will equal, oops, having trouble, equals minus 80, right? Okay, so that is just the IRR, it's 15%. It's also the yield to maturity, okay, which we've discussed in the past. Well, is the 15% high or low? Is it good or bad? Well, it's terrible. Cisco's charging us a higher interest rate than our cost of capital. In other words, we can go to the capital markets and raise the money for a loan at 12% as opposed to implicitly borrow from Cisco at 15%. Right? See, what happened is the IRR increased because the initial investment fell more than the future cash flows, right? Small payoffs on a really small investment can generate very large returns. We're dividing by small numbers here. Okay? See, but the NPV rightfully fell because Cisco's lending us money at an interest rate that's greater than our cost of capital. So the IRR spiked because we have this smaller upfront investment. That's very misleading. The NPV fell. It accurately captured the bad loan Cisco was inserting into the deal. And so the lesson here is that IRR projects can mislead when we're deciding among projects, whereas NPV will not mislead in comparisons. The larger the NPV, the greater the value. Now, let's briefly talk about a couple of additional bids, just to hammer home the point. We also heard from Juniper and Huawei, who had costs and cost savings for us as laid out in this table. And how would we rank these bids according to the IRR and NPV? Well, we know how to compute the IRR and NPV. We just replicate or repeat what we did for Cisco or what we've done in past lectures. And you can get this set of IRRs and this set of NPVs. And what you quickly see is that the IRR ranking is that the Huawei number 3 bid is better than the number 2 bid from Juniper, which is better than the number 1 bid from Cisco. The exact opposite ranking relative to what NPV tells us. Okay. And here's a picture of what's going on. I've got the discount rate. We've seen a picture like this before. I've got the discount rate on the horizontal axis, and I've got NPV on the vertical axis. And each line graphs the relation between NPV as a function of the discount rate. So at our cost of capital here, if we go up to each line, we can see the NPVs of each of the bids. And quite clearly, the Cisco bid on the green line is better than the Juniper bid on the red line, which is better than the Huawei bid, which is on the blue line. When we go over here where the lines cross the x-axis, right, these are the IRRs, right? By definition, the IRR is the discount rate where the NPV equals 0. Here are the Here are the IRRs. In this case, we see that the IRR for Huawei is much bigger than the IRR for Juniper, which is bigger than the IRR for Cisco. Okay? The exact opposite ranking according to the IRR rule, or relative to the NPV rule. What's going on? Well, if you look more closely at the cash flow streams, you can see that Huawei has small upfront costs. That increases the IRR, relatively speaking. And Juniper has front-loaded cash flows, which is going to increase the IRR relative to the Cisco bid. So one lesson is the IRR does not address differences in scale. And there's no better way to emphasize this point than to ask, would you rather earn 100% on a $1 investment or 10% on $1 million of investment? Well, quite clearly the latter. You're going to wind up with a lot more money. Okay? Some more intuition. Juniper's bid is actually like Cisco's with an embedded loan. Right? And you can see that here, where Cisco charges $100 million, then you get the cost savings. What Huawei is doing is it's giving you an $80 million loan and then charging you $40 every period, as opposed to the $35 million that Cisco's 1A bid was charging you. And if we ask what the loan is on this interest rate, right, what the interest rate is on this loan, we see it's 23%. The IRR to this loan is just 23%, which is much bigger than the 12% cost of capital that Wharton faces. Okay, let's summarize this. What are the lessons here? Look, internal rate of return is useful. It's a way to convey the attractiveness of a project or an investment in a manner that investors get returns. Okay. The problem with the IRR decision rule is that it only works or overlaps with NPV in certain situations when we're not comparing projects and when the cash flow signs are all negative cash flows preceding all positive cash flows. So I think the end message here is that use IRR in your project evaluation and your investment analysis, your capital budgeting. But be cognizant of the limitation. Know when to use it, know when not to use it. That's what's critical. So thank you so much for listening, and I look forward to seeing you in the next lecture, in which we're going to talk about, what are we going to talk about? Oh,
the cost of capital. Bye-bye.